nó là ví dụ như bạn chỉnh tích 50 thì là giá sẽ bằng 25 đô la Hoa Kỳ, tức là 25 đô la Mỹ. Còn nếu như mà bạn chỉnh tích 20 thì là chỉ là 10 đô la Mỹ thôi. Và sau đấy thì Xuyên và các bạn thử nghĩ xem là bây giờ trong 5 phút thì giá nó có thể tỷ lệ khả năng trong 5 phút giá nó move được 25 đô la Mỹ cao hơn hay là move 10 đô la Mỹ cao hơn, đúng không? Chắc chắn là 10 đô la Mỹ cao hơn rồi, đúng không nào? Đúng không? Đấy, thế là khung thời gian nhỏ thì bạn giảm tích xuống, khung thời gian lớn bạn tăng tích lên, nhưng mà tiêu chuẩn TPO thì là 50 đối với BitMEX. Mình nói luôn và các bạn tự tìm hiểu để các bạn xem. Đấy, còn mình chỉnh là 20 là để dành cho 5 phút mình scalp, và mình mà mình scalping hoặc mình đi top ấy, time average, time weighted average pricing ấy, thì mình sẽ cần khoảng độ 20 đến 10, thậm chí là xuống 5 để mình căn exact bottom.
Còn số 5 là nhìn được ngoài mắt.
Nhưng mà nhìn được. Đấy, rồi sẽ thổi tiếp.
Được rồi.
Đúng rồi, tiện là đúng rồi, nhưng tiện lại nó là phải trong context là daily nhá, tiện nhá. Đấy, còn một cái nữa này, khi mà giá nó đẩy về cái tail còn lại ấy, mà bạn không thấy follow up mà bạn lại thấy volume nó build ấy, thì bạn phải dừng ngay lại và bạn đảo chiều luôn. Y như ngày hôm nay này. Và còn một cách nữa nhá, là bạn mở hai chart XO lên, một chart Bybit và FTX, và ba chart, một cái Bybit, một cái FTX, một cái BitMEX. Bạn thấy Bybit mà short mà BitMEX không short ấy, net short nó không tăng ấy, thì tức là nhi đồng đang shorting. Đấy, nếu như bạn không có file print, bạn không đọc về file print như mình, và các bạn không dự tính được xem XO daily, xem TPO daily, hoặc là bạn merge vào, bạn merge session vào được, hoặc là bạn xem đấy như mình bảo, ôi 45.600 à, nhanh vậy, thôi thổi luôn đi.
Anh Nam anh cho em hỏi chút.
Chào biết anh.
Vâng, anh Nam anh có nói về cái vấn đề gọi là nó câu em hiểu có thanh khoản cụ thể nó là nào không?
Không phải câu là câu short đấy. Tức là cứ nhùng nhằng câu để cho người ta nhảy vào short ấy, tại vì mình bảo là cái lúc như bây giờ chúng ta đang nói chuyện với nhau này là đang ở trong cái giai đoạn mà mình hiểu là disbelief shorting. Cái move vừa rồi, cái năm vừa rồi ấy, nó được ignite bởi retail, tức là retail người ta short vì lý do mình vừa nói. Bạn xem Bybit bạn biết luôn, nếu như bạn nhìn real time data, bạn nhìn Bybit, hoặc là như mình biết từ sáng nay đấy thì mình biết là retail short. Và sau cái lúc đấy thì sau đấy thì nó sẽ đến một cái giai đoạn disbelief shorting, như chúng nói là gồng lệnh đấy, gồng lệnh đấy. Và sau đấy, và khi mình nhìn delta ấy, mình nhìn thấy câu kéo giá cứ nhấp nhửng với cả delta as imbalance as nó lớn ấy, thì mình biết là retail đang short, tại vì retail thì người ta không tỷ lệ người ta ít limit order lắm, mà mechanic của các sàn ấy, trừ BitMEX nhá, mechanic của FTX hoặc là Binance ấy, rất là khó để các bạn có thể fill limit short. Nếu như limit của bạn mà fail ấy thì là bạn bị cháy đấy, hoặc là bạn sẽ sai, tức là giá nó sẽ không dừng ở đấy đâu, nó sẽ đi lên. Nó liên quan rất nhiều, nó liên quan một chút tới toán khoan và cái cách mà các sàn operate, liên quan đến API. Tuy nhiên là mình có thể nói ngắn gọn là retail thường rất ít khi limit. Bạn đặt limit gần ở trong trường hợp như hôm nay ấy, bạn đặt limit gần như không bao giờ fill, hoặc là fill thì giá nó sẽ đi tiếp xuống hoặc nó đi lên tiếp chứ nó không dừng lại ở đấy. Không bao giờ bạn có thể làm được điều đấy. Bạn bắt buộc phải market order, và market order ấy, mà bạn market order size lớn ấy, nó sẽ tạo ra một hiện tượng gọi là fund run từ market maker, và nó sẽ hiện lên ngay ở delta. Mình nhìn vào là mình biết là có câu kéo, nó cứ nó phải câu đấy khoảng độ hàng giờ chẳng hạn, để cho người ta nhảy vào short xong thì khi nào mà các bạn tích tụ được short rồi thì suy lên thôi, lần nào thế, đơn giản lắm.
Câu mà build TPO đấy thì nó chạy.
Đấy
là sao thì chạy.
Nói chung là toàn thế đấy mà. Mình chơi quá lâu rồi, mình thấy cái behavior là nó liên tục không, nó chưa thay đổi ấy. Nó cứ như thế này suốt từ xưa đến nay rồi ở mọi market, tại vì con người có thay đổi mà, thế nên nó mới sinh ra cái behavior economic, cái đấy. Ví dụ bây giờ các bạn thấy Bybit đang short rất nhiều ở 4.5K7, mình đảm bảo sẽ lại squeeze cho xem.
Khi cháy sạch thì mới xuống được.
Khi nào cháy hết rồi, người ta flip long rồi thì lúc đấy giá sẽ tụt. Nó luôn là tại vì flip long thì người ta lại không hedge nữa, người ta lại không positioning for the other side nữa. Nhưng vậy mình bảo cái one standard deviation, more than one standard deviation move ấy, thì lúc đấy giá nó tụt, và người không hedging for downside nữa thì nó tụt. Và mình biết là cháy hết. Bạn nhìn thấy chút thay đổi ở behavior, các bạn nhìn thấy người ta không short, người ta flip long. Các bạn thấy cái tail nó được build dần một cách rất từ từ. Các bạn thấy có distribution, hoặc là bạn nhìn đến các bạn thấy có Quasimodo, hoặc các bạn thấy có head and shoulder chẳng hạn. Thì lúc đấy cháy hết mọi người long. Và tất nhiên có một số các kỹ thuật nữa, các bạn phải nhìn vào thời gian, các bạn nhìn vào option ở S&P 500, tại vì BTC là risk asset mà. Đấy, các bạn nhìn vào event cuối tuần này là Super Bowl chẳng hạn. Nên là có khi tuần này ấy, ngày bắt đầu chơi trận Super Bowl tuần này là top y hệt như là Elon Musk cái đúng 8 giờ cái hôm mà lên SNL ấy, là top của Dogecoin ấy, literally là top luôn. Kéo lên lại thế. Mà nó lại rất là gần cái cái ETF cho miner. Chung là tuần này là sẽ phải để ý đấy. Cái tuần này là các bạn sẽ phải chú ý một chút đấy. Đừng có trade tuần này, nhưng các bạn phải chú ý có vấn đề cái là có thể jump on board. Và các bạn nhớ đấy, bây giờ mùng 10 tuần sau option expiry ở S&P 500 kìa, mà mọi người đang bị rất ảnh hưởng bởi CPI ngày hôm nay. Thêm vào nữa tuần sau là giảm. Sau giảm thì liquidity quay trở lại Asian market, quay trở lại rất nhiều. Mà các bạn biết đấy, khi liquidity quay trở lại thì để xem Asia người ta làm gì.
Có dòng thì dân châu Á coi như là hoàn thành được cái cung chùa quay đánh thôi.
Quay lại chập như lòng thôi.
Quay đánh thôi.
Quay lại chập như lòng thôi. Đấy.
Hôm nay Covid thì có khi lại sớm hơn đấy, đừng có đùa.
Để mình xem hôm nay phân run nào, có thể là 14 để mình tùy, tại vì nó liên quan đến S&P đó. Năm nay quad witching là rất quan trọng chung ạ, tại vì thị trường đang on the edge mà. Mình sợ quad witching xong chắc hôm đấy chắc 2 giờ chiều là 1 giờ chiều là phải sao mình sẽ thử xem một sell the top. Nó tử tí. Chung là mà các bạn mà không thích short SP thì các bạn short BTC. Riêng downside nhá, các bạn mà bearish on S&P 500 đừng short S&P 500. Bạn đi short risk asset, bạn short Bitcoin ấy. Tại vì correlation là 11. Cả có một cái nữa là các bạn có thể nhìn nhá. Ví dụ bây giờ giá ở Bybit là 45.259, đúng không ạ? Giá ở BitMEX là 45.300. Giá nó lệch nhau tại vì sao ạ? Tại vì sao? Nó lệch không quá nhiều đâu, nhưng mà các bạn phải chú ý. Tại sao lại lệch nhỉ? Các bạn mở chart lên xem. Bybit thì dùng cái linear nhá, dùng cái USDT. Các bạn đã biết tại sao? Này, giá nó lệch phải đến 50 đô la Mỹ này. Tại vì người ta đang short nhiều Vinh ạ. Chỉ đơn giản thế thôi. Disbelief shorting. Disbelief shorting. Rồi các bạn sẽ thấy sớm thôi. God like candle. Không biết mình có sai không, nhưng mà hoặc đơn giản nhất các bạn mà thấy những cái 5 minute chart mà nó break market structure thì các bạn có thể consider de-risk. Nhưng mình nghĩ là có, nhưng mà nói chung là chắc không 15 đâu, chung là không sợ đâu. Bây giờ mà để short khoảng độ 14.600 là khá an toàn. Mà mình không financial advice nhá. Thêm cái nữa là các bạn nhìn TPO của CME hôm nay, tất nhiên là chưa hết phiên. Đúng rồi, không phải financial advice các bạn. Các bạn nhìn CME hôm nay nhá, các bạn thấy W value ở phía trên không? Value area 2 lại đúng là section 2 không? Và khi các bạn nhìn thấy thế thì các bạn sẽ thấy gì nào? Nếu như mà nó end CME ngày hôm nay như thế này thì các bạn nghĩ là nó sẽ lên tiếp hay xuống nhỉ? Mình sẽ đấy. Nó sẽ break, đúng rồi, nó sẽ break tiếp. Lý thuyết rất đơn giản TPO. Đôi khi là nó không, trong một số trường hợp condition nó quá đặc biệt thì nó không, nhưng thường phải đến nó là plus EV chết, tức là nó là plus EV chết, cho nên là các bạn nên luôn luôn expect điều đấy. Đấy thì
Tôi này vẫn giữ áp vẫn năm.
ôi trời ơi,
Để xem một tí, để xem tí nó có nhả. Mình nghĩ là xuống dưới một tí nó nhả đấy. Nhả dần ít này.
Ôi chưa Trung ơi, ôi rồi chưa đâu Trung nhìn bài bit này, ôi rồi ôi.
Bài bit thì mình không coi.
Bài bit đang sell the rip. What the fuck is bài bit doing, man? What the fuck? Mình nói thật với các bạn là mình là một người
Mình phải coi cái bên Bitback cái đầu Bitback nếu mà nhả là mới sợ. Vì
không
này
đâu. Mình thấy số lượng check out chưa nhiều, chưa sao đâu. Nó mà break market structure chẳng hạn thì lúc đấy tính sau. Mà
cái đầu này vẫn giữ này, đầu này vẫn giữ mạnh phết đấy.
Mà thật sự với các bạn, nói thật với chung với các bạn, nhiều khi mình chưa nhiều mình xem mình thấy rất là buồn vì behavior của người ta không thay đổi từ trước đến nay toàn thế. Nên là, đấy, các bạn học ở đây thì các bạn đừng như vậy. Chứ chơi mãi bao nhiêu thời gian thì cũng chán.
Thôi chắc là xuống Telegram đi.
Ok. Trade so với volume lên, tức là sao nhỉ? Để mình trả lời nốt câu hỏi của anh nhé, câu hỏi cuối cùng. Mình không hiểu lắm, trade so với volume tức là sao?
Có nghĩa là có hai thông số, một là khối lượng trade, khối hai là khối lượng volume ạ.
Trade count đúng rồi.
Trade count thì có cái gì cần lưu ý các bạn? Trade count
cái này thì để order flow mình dạy, nhưng đại loại là trade count rất quan trọng vì nó liên quan đến mechanic của sàn. Tức là nếu như các bạn đo được ping ấy, các bạn nói biết được Python ấy, bạn đo được ping ấy ở top hoặc ở bottom ấy, ping luôn luôn bị sai. Với cái API bình thường, tức là ví dụ như bạn mà ping sàn ấy bằng máy ấy, luôn luôn bị sai, luôn luôn bị sai. Các bạn biết tại sao không? Đúng, bạn biết tại sao? Các bạn nhớ câu hỏi của mình là retail không được buy được top và bottom không? Nó spy để cho các bạn nhìn sàn nào cũng thế à? Hoặc là bị thoát bị chậm bao giờ cũng thế à? Thế nên khi mà spy nó sẽ gây ra một hiện tượng, nói chung các bạn hiểu đại loại là nó gây nghẽn thì nó sẽ bị dồn số lượng chết cao lên, đại loại là thế. Nó có một số cách sử dụng khác nhưng mà bạn hiểu nôm na thì cũng được, kiểu đấy. Còn volume thì đi cùng thôi, đi cùng với nó thôi. Cái concept đấy mình hay xem cái Exo này nó có đấy. Thế là các bạn sử dụng này thêm một ít tool để đi luôn, các bạn đi ping những cái sàn như kiểu Bybit hoặc FTX ấy, đi ping Bitmex ấy, trong monitor nó. Đấy, nên là cái được, cái API của bạn là như retail bình thường mà. Còn ví dụ như những khách hàng đặc biệt thì người ta sẽ có API riêng. Đấy thì nó sẽ không bị lag, nó không bị lag. Và một ví dụ nhỏ nhá, nếu như các bạn mà limit order mà các bạn được fill ấy, ví dụ như kiểu cái lúc mà tháng 5 năm ngoái ấy, các bạn fill limit order ấy, 30.000 đô tròn ở Coinbase ấy, nhá. Hôm đấy Coinbase giá đáy của nó là 30.000, ngày giá thấp nhất của ngày 19 tháng 5 là 30.000. Và bạn fill được cái giá 30.000 đấy thì nó không bao giờ là đáy nhá. Các bạn play vào bao cho các bạn phải bán ngay. Hãy nhớ điều đấy, luôn luôn nhớ điều đấy. Các bạn không bao giờ có thể fill được limit order mà các bạn sử dụng tài khoản bình thường. Thật sự ra mà nói thì cái cuộc chơi này nhiều lúc nó không quá là công bằng, nhưng mà mình có một số cái nhắn nhủ thì mình chia sẻ với các bạn. Đấy, có thế thôi. Thế thì Trung có đi thêm nào không? Không thì mình kết thúc buổi học. Trung rồi. Sếp ơi. Hello. Đấy, các bạn ở đấy, các bạn nhớ điều đấy. Mình đây có một vài điều như thế muốn nhắn nhủ các bạn để làm sao đấy tôi chơi đừng có để cháy. Đây, market structure bây giờ là đang bằng equal này. Tụt nó thì tắt. Để xem nào. Để xem như thế nào. Để mình xem nào. Của cái hôm trước nào, bao nhiêu rồi? Chưa lên, chưa lên đâu. Cuối tuần này chắc phải hỏi Trung hay để cuối tuần mình nói về macro nhỉ? Cuối tuần Trung này thôi, có đi thôi để Trung ấy cũng được, thôi để Trung để mình xác định. Các bạn từ thứ bảy các bạn có thời gian không? Mình sẽ nói về có bom nổ chậm MicroStrategy. Hôm nay hy vọng là các bạn cũng đã được chứng kiến một số các kỹ thuật, các bạn cũng mua được BTC đấy. Mình cứ để mình xem lịch của mình các thứ thế nào nữa đấy. Mà nó cứ để cứ để xem thế nào. Ví dụ trực quan và sinh động, nên đi học này có ví dụ thì các bạn mới hiểu bài hơn đúng không? Quá hiểu bài được gì nữa. Quá hiểu bài được gì nữa. Đây là đây đây là một cái chart đẹp, rất đẹp. Đây là một cái chart đẹp, rất đẹp, rất đẹp. Đấy thì các bạn cứ xem không mới được thì mình mua Barrick được, mua GLD được. Chào chào mọi người. Pattern 10 năm bị uy tín chứ, mình ít chơi cái này lắm, mấy cái kiểu pattern lâu rồi ít mà nó ít có ấy, không chơi hơi phí, không chơi phí quá. Ừ. Không chơi thì phí, rất tiếc. Xem nào. BTC chót quá nhỉ, mình vừa bảo các bạn là hôm trước với qua nhìn và các bạn qua nhảy vào tưởng tí đu đủ được một tí gãy tay phải cắt, may mà có tí hay, mình mất 15%. Chào anh, chào mọi người. Vừa nãy mình có bạn tí nữa 3 buổi mình sẽ bảo mình nói chuyện về VTC. May mà có một cái setup trước này còn được. Hôm qua vẽ được 2 đáy xong không đẩy được spot seller nhiều quá. Thế à? Ôi thế là các bạn hơn mình rồi. Các bạn thấy chưa? Mình đánh không bằng các bạn. Mình còn đi cầm lên 47 cơ. Mấy anh mới chưa có pass đâu. Thế à? Để mình xem nào. Anh nào nhỉ? Ui rồi, vẫn không đi. Đấy bây giờ mình đang phải tìm. Đâu, mình có thấy bạn nào xin password đâu nhỉ? Không biết là chúng đang ở đâu. Chúng đang ở đâu? Rồi. Ok, được rồi. Nào, để chúng ta xem nào. Xong mình sẽ phải đợi Barrett retest thì nó mình sẽ chỉnh. Chả lẽ fake out 2 lần? Khó quá nhỉ. Nhưng mà đây thực sự là gì là sign of weakness đấy. Các bạn sẽ thấy rất là rõ ràng. Ok, chiều. Dùng năng lượng ý các cụ cứ thế câu sự là đánh mình không biết là có đánh nhau không, thực sự cái này mình không biết, để mình check đợi để mình check xem có gì hay không. Thực ra cũng không thấy gì cả. Thật ra là mình chỉ thấy quân Nga tiến vào ấy thôi, tiến vào một cái thành phố cái gì cái tên là gì, Luhansk ở bên nọ đổ bên kia đổ bên còn lại, nhưng mà thấy mình thấy hình như bảo là Mỹ rút quân nói sao. Năng lượng bảo ý hay cha. Ui rồi, USDC IPO này, Circle, mỗi lần mình thấy cái crypto nào IPO thứ là mình PTSD, mình lại thấy bồi hồi. Đấy. Vừa mới sáng ra đã little to no warning. Haya, what is it Haya? Chào mọi người. Chào Hùng. Chào. Chưa vừa nãy short sao này, chưa thấy gì cả. Thì nó chỉ cho các bạn mấy cái kiểu test bằng đánh bằng delta ladder kết hợp với gì nhỉ, candlestick. Ôi trời ơi, mà sẽ rơi về đâu đây? Rơi về đâu? là còn sửa chưa xong. Cái này nó là trông có vẻ hơi trouble. Xem là 4 hours 4 giờ. Hôm nay mà không vào được thì chào trang cho mọi người. Mình vẫn quan điểm option expiry trước 11 giờ bán nhé, để là BTC. Các bạn long short thì các bạn giữ được vì riêng ở cái cycle này thì mình chắc chắn sau 11 giờ sẽ có weakness nếu như mà có. Chưa kể tuần này quá nguy hiểm, 20 là ngày hết Olympic. Để xem. Cái mà các bạn level của mình weekly kể nó pump lên đây được 45.000 cách có 50 đô la Mỹ mà mình có nguyên tắc là mình không short. Nếu như mà mình dùng PA thì đúng chỗ em mới short, còn nếu mà mình short bằng hay là TPO thì nó phải cách xa xa là tỷ lệ đây là cách 50 đô la. Đúng là bị chơi chả thật đấy. Alo. Các bạn đợi mình chút nhé. Chào mọi người, mình đang chỉnh lại nốt về cái đồng mạng cho mình khoảng 2 phút. Hôm nay thầy Trung vào sau chắc độ 30 phút thì mình sẽ giảng dạy phần lớn. Thầy Trung sẽ vào nói một số phần râu ria. Không phải râu ria mà phần bổ trợ thêm vào. Đấy, để giúp cho các bạn. Chúng ta có 35 chỉ muốn 34 34. Nếu mình có mấy bạn nhỉ? 37 36 37 36. Đấy, vừa nói xong mình có thêm bạn vào đây. Thêm vào. Ok. Đợi mình chút nha. Đây. Ok, chào mọi người. Đây là và mọi người có nghe rõ mình nói điều nào? Nghe rõ có bị nhỏ không? Để mình kéo cái microphone nó gần một chút. Ok. Ok các bạn. Nào. Hay là nào mình hôm nay đây mình share screen. Share screen. Wait. Quit. Ok. Được rồi. Anh đi này. Ok, mọi người nhìn rõ không? Ok, chắc là mọi người nhìn rõ này. Hôm nay chúng ta sẽ học về mình hay gọi là tác động vật lý. Chúng ta sẽ học về data. Mình giảng thêm một chút về VPO, data bit ash và một kỹ thuật một vài kỹ thuật để trading bằng data. Thì đầu tiên từ trách nhiệm tất cả những thông tin đưa ra hôm nay chỉ mang tính chất thuần túy, không chứa đựng là tài chính. Những nội dung sau của hôm nay thì mình sẽ nói về hai dạng dòng chảy, tiếng Anh gọi là flow, flow chủ động và bị động. Cái này nó là cái gì? Tiếp theo nữa là đây là một cách để hút nhi đồng rất là hiệu quả. Các bạn thì sử dụng hoặc các bạn thì dùng nó để nhận biết, để nhìn, để biết, và các bạn cần áp dụng bối cảnh của kỹ thuật luyện tốt để thành thạo trong cái việc này. Đầu tiên là mình muốn lại về TPO một chút. Mình muốn nói đến cái việc tại sao hôm qua mình bảo với các bạn là biết được cái vùng này thì một cách để các bạn phát hiện, ví dụ nhá, đây là mình lấy một cái ví dụ, đây là một cái TPO breakout chuẩn này. Cái TPO ngày hôm qua này, cái này nó là một cái breakout chuẩn, breakout tiêu chuẩn, tức là ít nhất là theo cái quan điểm của mình, TPO này là một cái TPO breakout tiêu chuẩn. Vậy thì một cái TPO breakout tiêu chuẩn thì nó sẽ có những cái gì? Mình lấy một ví dụ nhá. Bạn có một cái TPO như này đi. Đấy, đây là theo. Nếu như mà các bạn muốn thấy một cái breakout tiêu chuẩn này thì cái đầu tiên và cái tốt nhất là cái vùng value area của nó và được ví dụ breakout nó nằm ở điểm này là điểm breakout chẳng hạn, thì cái value area của nó nên nằm trong những cái này, nên nằm trên cái khu vực breakout. Cái này nó có nghĩa là cái mà mình nói để cái việc build value và sau đó nó nói tiếp tục build value quanh đây nữa và nó đi liên tiếp. Đấy, và khi mà nó đã có value area ở trên khu vực breakout ấy, thì khi giá quay trở về test cái edge of balance ấy, mà dưới này nó được build volume nhiều như này thì khả năng nó được bật rất là cao. Tức là đây là một cái plus EV structure, một cái plus EV trade, tức là một cái trade mà các bạn có tỷ lệ thành công cao. Nhưng ngược lại, nếu như mà các bạn thấy một cái TPO ấy mà nó cũng như thế, nhưng mà cái value area của nó ấy, nó lại nằm ở một cái khoảng rất rộng, và trong đó cái breakout nó nằm ở lưng chừng chỗ này. Mà nếu ngày hôm sau nó không chạy luôn ấy, mà nó quay lại test ấy, thì tỷ lệ khả năng xịt nó rất là cao. Tại vì sao ạ? Tại vì cái vùng value area của nó quá rộng, và chúng ta đã có luật là khi mà giá chạy trong vùng value area và người ta đang muốn build value ở quanh cái vùng đấy, giá nó sẽ chặn các cạnh. Tại vì ở POC thì nó sẽ chót nhất, nhưng mà nó sẽ build value ở quanh cái này. Tức là nếu như nó không chạy luôn nhá, mà nó consolidate, nó gọi là đi ngang đi chẳng hạn, đúng không? Thường các bạn thấy một số breakout xong nó thì đi ngang, mà nếu cái ngày breakout ấy mà value area của nó quá rộng ấy, thì các bạn cần phải rất cẩn thận. Như cái hai lý do mà mình chấp nhận là biết ngày hôm qua, thứ nhất là edge balance này, thứ hai là mình nhìn thấy ở dưới này nó có rất nhiều volume, mà khi nó có rất nhiều volume như buổi trước mình chỉ cho các bạn ấy, thì khi giá nó enter cái vùng này bình thường ra thì nó sẽ gây việc chop như này, thì tức là sẽ có phản ứng. Cho nên là khi mà giá về đây mình expect đây là một cái retest tốt và là nó sẽ đi liên tiếp, tất nhiên là short seller nó quá nhiều và cái setup này nó bị fail. Nhưng mà ví dụ như kể cả setup này có fail, khi mà các bạn nhìn lại nó ấy, mà các bạn thấy có những setup như này, breakout thế này nhá, đây mình tìm phải sao lại, nhưng đây là để breakout sao, đúng không? Đây là để breakout nhá, breakout xong build value như thế này, và ở dưới nó có một lượng volume vừa đủ, lớn càng tốt, càng lớn thì càng tốt nhá, nhưng như thế này là vừa đủ, nó không phải cái này, nó không ít như thế này, mà nó không chỗ này nó rất là đều đặn. Thì khi mà giá nó quay lại, kể cả ví dụ như một là các bạn có thể nhìn nhận nó ở một cái là retest của một cái breakout và nó sẽ continuation. Còn nếu như các bạn thấy có điều gì đấy không ổn đấy, các bạn hoàn toàn có thể cắt sớm, tại vì gần như 100% những chỗ này là nó sẽ có bật. Và như hôm qua đấy thì các bạn sẽ thấy nó có phản ứng. Các bạn hiểu không ạ? Mình muốn nói cho các bạn nhớ rõ nhé, những cái breakout mà cái value area của cái này breakout nó không rộng ấy, nó không trải dài kiểu vậy, mà nó tập trung lại ở một cái điểm ấy, thì những cái breakout đấy tỷ lệ thành công cao hơn là những cái breakout khác. Tại vì sao? Tại vì đấy luật đấy, nó đến edge of balance này, nhiều volume thì sẽ bật lại. Các bạn hiểu ạ? Nó sẽ gia tăng cái tỷ lệ trend continuation cho các bạn. Nhưng mà ngược lại, những cái TPO mà nó lại bình tĩnh, nó lại breakout xong cái value area nó nằm khoảng như này chẳng hạn này, mà sau đấy giá nó chop lên chop xuống ấy, thì là các bạn nên tin tưởng cái TPO này với một độ khả tín thấp hơn. Các bạn hiểu chưa? Các bạn nào có câu hỏi gì không? Chúng ta có câu hỏi không? Đây, qua mình chỉ có chỉ cái này. Ok, được một chút. Đây, rồi. Edge of balance tức là này nhá. Trong những điều kiện bình thường, đúng không ạ? Nghĩa là khi mà bạn breakout ấy, đầu tiên này là chúng ta có thợ sửa, đúng không ạ? Các bạn nhớ là thợ sửa luôn sửa theo trend nhé, đừng có bet in thợ sửa một trend, người ta sửa thì người ta sẽ sửa theo trend. Đấy, thì khi mà giá nó breakout như này, trend is up, đúng không ạ? Và nó tạo một cái vùng value area như nằm ở trên cái chỗ breakout. Đây vừa là chỗ lõm, nhưng mà mình nhớ đây vừa là breakout như ở đây. Đấy, từ vùng này đến vùng này là chỗ là nếu như mà các bạn thấy cái TPO của cả cái ngày breakout đó nó build value area nằm phía trên, chúng ta đã có, và ở edge of balance này, tức là hai cái đoạn này, cái đoạn mà nó dưới đoạn breakout các bạn thấy có nhiều volume tụ họp vào, thì cái lần retest đầu tiên ấy gần như là các bạn sẽ bật, các bạn hiểu, nó có thể trên continuation như là bình thường, tức là bật lên và chạy tiếp, hoặc là đấy như hôm nay bật lên xong nó tụt xuống. Hôm qua mình đã đi là bật lên và nó chạy tiếp, vì mình thấy có rất nhiều volume ở đây, nó như là một dạng nó cản ấy, như là kiểu các bạn cảm thấy đây là resistance, đúng không ạ? Tại vì cản mà flip resistance thì nó thành support, cho nên khi nó retest ấy, thì các bạn rất là nên biết, chứ đừng nha. Mình biết là bây giờ bạn nào mà short để đợi phiêu lõm thì các bạn chính xác, nhưng bình thường nếu như trend continuation ấy, tức là tiếp tục trend ấy, thì lúc đấy những cái này nó sẽ quan trọng hơn là chỗ lõm ở dưới. Đấy, chưa kể đến việc mình đã nói 2 tuần nay chưa có một cái lõm nào do Swiss bị, đây cái màu xanh này, do Swiss bị fail. Đây là cái đầu tiên mà nó chưa fail hết rồi. Và sau khi cái này phiên đầu tiên thì nó là sign of weakness. Đấy, thì mình muốn chia sẻ cho các bạn. Mình thấy có dễ hiểu không? Các bạn có hiểu không? Còn ví dụ các bạn mà nhìn thấy cái breakout nào mà ví dụ mà như này chẳng hạn, như cái TPO mà mình đang ghi chuột này, mà nếu ví dụ như phần breakout của nó nằm ở chỗ này chẳng hạn, nằm ở lưng chừng ấy, thì nếu như ngày hôm sau nó không chạy luôn ấy, mà nó cứ lơ lửng quanh cái balance này, thì rất là nguy hiểm, tỷ lệ fail rất là cao. Tại vì nó có luật là giá để chạy cứ edge balance mà nó chạy, mà nó build value mà. Bạn hiểu không? Tại vì sau cái ngày breakout thì participant đang muốn tìm một cái ví dụ những cái giá những cái giá trị mà nó hợp lý để cho phiên đấu giá, đúng không ạ? Thì nếu như ngày breakout mà những cái người người ta đẩy breakout mà giá hợp lý nó chỉ nằm trong một khoảng, thì người ta sẽ explore giá trị ở trong một khoảng đấy. Còn nếu như nó rộng như này thì nó có explore lên trên hoặc explore xuống dưới. Nhưng mà ý mình là nếu như mà nó vẫn chạy quanh một khoảng ấy, thì các bạn cần phải rất là cẩn thận. Nó không chạy luôn mà nó consolidate thì các bạn phải rất là cẩn thận. Cái ngày hôm nay này, các bạn nhớ về mình cách về cái mà mình bảo hợp nhất profile không? Nếu như ngày hôm nay US session này và POC nó ship về xuống dưới này, thì cái phần này là fail breakout. Các bạn nhìn PA thì các bạn chưa ra nhé, nhìn PA thì có thể chưa nhìn thấy, nhưng nhìn vào đây là các bạn có thể thấy ngay vì value area nó ship xuống dưới. Bây giờ chúng ta cần phải đợi US session. US này rất là quan trọng. Các bạn hiểu chưa? Mà đây mình cũng muốn nói thêm một tí về BDC, vừa nãy mình nói chuyện với bạn con nhì. Đấy, mình chỉ ví dụ như hôm trước nhá, xóa hết đi. Như hôm trước mình có bảo là đây các bạn thể short cluster này, đúng không ạ? Short ở đây, target ở dưới này. Chúng ta đã có target, đúng không ạ? 40k xung quanh cái vùng này, đúng không ạ? Chúng ta đã có dán make 222. Technically speaking nhá, tức là theo kỹ thuật nhá, các bạn có thể thấy high low quanh đâu đấy, quanh đây, nhưng với việc ở dưới này sửa chưa xong, mà lại nhìn như là fail breakout, kể cả ở dưới này nó có xuống đây thì các bạn có biết, các bạn có hiểu, các bạn có mua, các bạn có hiểu cái ý tưởng của mình không, cái mà mình vừa nói không? Nhìn market structure thì nhìn nó rất giống như là kiểu một dạng 222 trong cái lower high, nhưng nhìn TPO các bạn sẽ thấy một cái bức tranh khác. Và ví dụ nếu như cái vùng này nó đáy nhá, thì các bạn sẽ thấy đáy này nó thấp hơn chỗ này. Nếu mà các bạn nhìn nó rất giống nó xích, mình không hiểu tại sao mà mình luôn luôn thấy mấy cái này kiểu giống BTC 6K. Hồi đấy chơi quanh bear market chơi nhiều quá nên là đấy, thì các bạn sẽ thấy có cái điểm khác biệt như thế. Vậy thì bây giờ nên làm gì? Đấy, hiện tại thì mình cũng có một cái setup nào cả. Mình nghĩ là và các bạn thấy một điều rất trường hợp nhé, các bạn nhìn này 41.400 đến 41.800 đúng không ạ? Nếu như các bạn nhìn vào daily structure, các bạn nhìn vào daily, các bạn thấy nó gần cái swing low, nó gần với daily support nhá. Và daily support này được build ở ngày cuối tuần, mình không đặt nhiều niềm tin vào nó lắm, và đặc biệt là nó gần cái swing low. Nếu như mà bây giờ các bạn đã có short setup một kia rồi, bid 41 ra rồi, các bạn nó mà ra xuống đây break market structure ấy, quay lại đây thì chỗ này là very good short, hoặc thậm chí là ở dưới này nếu bạn muốn bid forward, mình nghĩ là sẽ bid khoảng forward vào daily, các bạn top sell, top là có thể buy và có thể selling nhá. Sau đây là continuation to the downside, at least là xuống 38.000 theo PA, và nếu mà xuống 38.000 là nó sẽ fill cái này fill cái lõm này là 38.200. Các bạn hiểu không ạ? Bây giờ mình cứ từ từ đấy, thì các bạn có thể mà xuống 38.000 mà không thể có volume, không thể xuống 38.000, mình nghĩ khả năng rất cao thì có bao đến đây để nó retest vào nó gì tiếp, hay nó vượt lên thì lúc đấy chúng ta cần phải đợi phản ứng ở cái giai đoạn này. Cái này rất là quan trọng, cái vùng này bây giờ trở nên cực kỳ quan trọng, các bạn hiểu chưa? Đấy, cho nên US session hôm nay rất là quan trọng, US session và in a way pre-close rất là quan trọng đấy, tại vì trên này nó có rất nhiều vấn đề. Bạn nhìn này, cái này Valentine nó vẫn là 44.500, ở phía trên vẫn còn một số các vấn đề, nhưng mà nhiều spot seller họ vào quá thì mình phải theo trend, đừng có đâu đi ngược trend. Nếu như mà đã nhìn thấy này, bờ để xem POC ship về đâu, nó mà build value ở đây, ship POC xuống đây thì hay trông có vẻ hơi nguy hiểm đấy. Xem nào, quickly thì vẫn thấy cách một chút thôi. Nói chung là chúng ta vẫn mình nghĩ là vẫn có range cho 35 đến 45. Bạn nào mà gọi là thích quá thì có thể dùng cái swing low ấy, nhưng mà mình dùng cái 35. Cái 35k level nó còn là chỗ lõm của VP, nhưng mà mình dùng nó. Dưới này còn 20 cho mình xem. Đọc cho. Dưới này còn 28k, 28.100 đến 29.300 nữa. Đấy. Nói chung là sẽ cần để ý. Đấy. Với, một cái vấn đề nữa với cái một cái mình gọi là poor low và poor high. Nghĩa là những cái TPO, những cái đỉnh hoặc đáy của cái TPO mà nó có hai viên gạch này. Thì một là nó có hai viên gạch, thứ hai nữa là các bạn thấy cái TPO kiểu này nó cũng là TPO không được tốt được. Những cái TPO kiểu này cũng có thể không đến mức được coi là poor low poor high, nhưng mà cái độ gọi là bình thường là các bạn cũng cần phải để ý đến cái này. Tại vì và những cái này là để ý gì? Các bạn cứ để ý những cái TPO mà nó đường chéo ấy, ở đuôi hoặc ở đỉnh ấy, nó đường chéo như kiểu này. Oh shit. Đường chéo nó đường chéo như kiểu này. Đây là một cái TPO, đây là một cái TPO, nghe kiểu theo cái đường chéo thẳng hàng đỉnh hay đấy là như thế thì khả năng bị test lại của nó rất là cao. Tại vì sao ạ? Tại vì nếu như mà các bạn nghĩ mỗi một cái section nó cứ đi chậm đi từ từ, đi từ từ lên, đặc biệt là ở cái phần đuôi ấy. Ui chúa, giật cơ mình. Bạn nào đang short, bạn nào đang short đấy, rất kéo mình. Ôi trời ơi, thôi hôm nay đây không phải là tác phẩm của mình nhá, mình có thể khẳng định các bạn. Trên sao này, what the fuck lagging? Ôi slow lag à? Em đi xa quá. Thôi nó sửa rồi bạn ạ. Này các bạn đừng có phết nhá. Đấy thì anyway, ui trời ơi, what the fuck is this? Ôi chỗ này sẽ được retest, đừng có bạn nào mua bây giờ nhá, để mình nhìn hôm nay học cái lâu tí từ từ. Ui cái gì thế này, what the fuck is this? Các bạn nhìn này. Ôi lát nữa mình sẽ dậy luôn, đừng không được, các bạn sẽ được phiêu. Các bạn muốn mua đi, nếu các bạn thực sự muốn mua đặt limit ở đây 41.320 để mình xem. Các bạn chơi ở đâu nhỉ? Mình xem ở FTX nhá, mình xem ở Binance nhá, để xem nào. Ôi hôm qua mình vừa bảo bạn Trang là mình cứ nghĩ hôm nay có nút đúng là được 42.265. Trời ơi, đây là mình tắt bớt cái này đi. 42.265. Ui trời ơi, để mình nhìn con tí, cho mình chỉ các bạn tôi đặt limit luôn, tí mình cho mình chạy tiếp, không mình đã quên. Ôi trời ơi, cái gì này? Ôi trời ơi, wow wow, đây đúng là cái lưu ý của Tôn Ngộ Không. Các bạn có xem phim Tôn Ngộ Không với đường tăng? Được rồi, ok, mình sẽ chạy tiếp nhé. Đặt cho mình mình đang nói đến cái gì nữa nhỉ? Đừng có biết ở đây mình vừa nói xong, đừng có biết. Ok, ôi các bạn nhìn ghép này, trên Bitcam có ghép ạ. Có ai spot rồi, đứng nào, đừng xem nào. Rồi, được rồi, ok. Tiếp nào. Đúng rồi, cái này là gợi như ý. Vì anh muốn hỏi đúng rồi đây, vì ví dụ đây, cái này thì cái này nó sẽ được phiêu, nó 100% nó sẽ được phiêu. Nếu như bạn nào rất muốn mua, các bạn phải gọi là các bạn không chịu được, các bạn rất muốn mua limit order từ từ. Đây, đây cũng có phản ứng này. Vừa nói xong đây. vừa nãy vừa vẽ xong. Nhưng mà thôi đừng mình thật là đừng có mua, mình thật là đừng có mua cái structure này. Hình như cụ tổng đang xin vào à? Trung ơi, như Trung còn nhầm group Trung ơi. Trung ơi. Hình như Trung vào lộn group. Invite Trung vào. Các bạn đợi chút nha. Vừa nói xong có ngay phản ứng. Ok. Đấy thì bây giờ nếu như mà các bạn muốn biết, các bạn thật sự muốn biết, mình nghĩ là bây giờ các bạn làm này. Mình không khuyến cáo biết nhá, nhưng bạn nào mà rất thích, bạn nào mà thích biết, bạn biết ở khoảng 1 này, 2 này, 2 3 4 5 41.200 trên Bitmax, các bạn mở các sàn tương ứng ra và các bạn đến khoảng độ 5 cái TPO chỗ này thì các bạn biết chỗ này sẽ được phiêu. Bạn cứ yên tâm là nó sẽ phiêu. Chỗ này các bạn thấy không ạ? Nó chỉ liquidation nhiều, chỗ này dưới này không có liquidation, dưới này nó spot selling. Ai đấy đang biết một cái gì đấy mà người ta đang bán rất là mạnh. Các bạn cần phải rất cẩn thận. Các bạn cần phải rất cẩn thận nhé. Đấy, đấy Trung vào rồi. Không mình hướng dẫn cho các bạn TPO đang vừa vẽ xong lúc luôn. Phải đây không phải là mình nhá, mình không làm gì cả. Đang ngồi làm.
Nhưng mà không sao đâu, nó không chắc xuống được.
Mình bảo là limit order thì xuống dưới này mà limit, không, nhưng mà Trung ạ, structure đang thực sự đang hơi xấu. Nếu như hôm qua là cái vùng mà nó cần được bao, Trung hiểu ý mình không? Nhưng mà bây giờ nó không bao được. Bây giờ Trung nhìn structure 4 hour, Trung nhìn như thế này, nhìn thấy giống 6K không?
Ủa sao biết mấy cái khác hả?
Thế à? Từ từ nhá.
Biết mấy cái khác á, tự nhiên bị data bị lỗi đó.
Nhìn từ lỗi á.
Data bên đó bị lỗi.
Để xem nào, xem mic nào. BTC USD không có Bitmax ở đây. Chúng ta nhìn thấy cái gì Trung?
Mấy anh phải gọi là
Đúng rồi.
Mấy cái số 41 30 rồi.
Đây. Ôi trời ơi.
Nó phiêu hết rồi đâu. Còn lộ cái nó tóc ở dưới nó phiêu hết rồi.
Shit. Wow. Nhưng mà dưới này Trung nhìn thế này lõng thế này, chung là mình không tin cái đầm lắm này. Trung nhìn thế này, Trung bảo mình đây là bottom á. Này, Trung nhìn này.
Nó có một cái gì bị hình như là bị support nó đẩy một cái xuống.
Support đẩy, at least mình nghĩ là phải retest low. At least retesting the low.
Mình coi lại xem.
At least retesting the low, hoặc nếu các bạn không muốn retest the low, at least biết 41.350.
Mất 30 rồi mà. Mất 30 nó phiêu rồi.
Nhưng mà như thế này thì mình nghĩ là chung là mình thích
cái này là có một đồng chí nào đó đẩy support, mình nghĩ là đẩy support hướng cái future đấy chứ không phải là tại vì là future gần như là đóng hết vùng dưới không có gì cả.
Mà ngày mai là option expiry.
Đúng rồi, ngày mai option đó.
Mình có bảo là sau 11 giờ sẽ có weakness. Nếu như mà các bạn nghĩ cái cycle này hiện tại là volatility nó đang support for to the market, sau 11 giờ chắc chắn sẽ có weakness. Nếu như nó tiếp tục correlate thế này thì mình nghĩ là không ổn. Mình chưa từng thấy trong đời mình một cái bottom nào mà
đúng đó, nhìn rất lạ, nãy mình đang nhìn mà
mình chưa thấy trong đời mình có bottom nhiều không này các bạn ạ.
Đây nhận các bạn thì sang này thế mở luôn. Tại vì là cái structure rất là một người, cái là nó bị rỗng một đoạn khá là dài, một khu vực khá là dài, rỗng hoàn toàn không có một cái order nào đây cả.
Nó giống như cái kiểu Trung nhớ Trung có xem hôm thứ bảy mình bảo Trung không thể có ai 56 phút liên tục không có order nào mà.
Đúng rồi.
Xong mình đẩy thử lên xong rồi không thể có ai, mình sợ có ngày luôn mà. Rất là lạ đấy. Chung là đang
có một chút xíu cái limit là ở 43 là 43 năm đấy.
Ý là có từng
không biết quá. Chắc là đồng chí là lucky cái đây rồi. Bên này chạy.
Mình nghĩ là đừng có mua bán gì. Cái này là quá bất thường thế này.
Chắc là quá bất thường.
Cái này là
gần như không limit luôn đấy, không có một cái thanh khoản nào mà đấy cả.
Mà bottom creation bằng limit order mà chứ không phải bằng gì đâu.
Cái này là support đẩy rồi.
Đấy, cái này mình nghĩ là cần cẩn thận. Đấy, quay lại bài học các bạn nhớ nhá, là những cái TPO này như là mình chỉ này. Đấy, nếu như hôm nay US session mình vẫn nói lại nhá, mà nó ship POC ở về dưới này thì mình biết là mình dạy các bạn là breakout lần 2 khó xịt, nhưng mà chắc là mình sẽ phải nói là breakout này rất là nguy hiểm, mà bạn nào mà chưa cắt thì nên cắt. Cái US session hôm nay rất là quan trọng, và đặc biệt chưa hết US session các ông đã làm này rồi. Đấy, các bạn nhớ nhá. Ok, thì mình sẽ tiếp tục. Setup VP trong trading view, bạn nào mà muốn dùng VP ở trong trading view ấy, thì hôm trước mình nhớ là mình nói với bạn Minh Hưng hay bạn nào đấy, nhưng mà các bạn nhưng mà mình chưa nói rõ, thì ví dụ VP các bạn có thể dùng hay là cái Trung hướng dẫn ngay đó là những tí nữa nhá, thì mình xong rồi mình cứ nói nốt phần này, xong rồi có gì thì mình nói trong TPO rồi, bây giờ mình sẽ nói về passive với cả passive và flow và active flow. Đấy, đấy, xong rồi sau đấy thì Trung nói về bid ask footprint. Đấy, xong rồi sau đấy thì mình nói về delta và mình nói về trading bằng data. Đấy, thì bây giờ mình muốn nói cho các bạn này, trong thị trường nó có hai dạng flow, tức là hai dạng order dòng chảy. Một nó là active, hai nó là passive, tức là một cái là chủ động và một cái là bị động. Các bạn có thể hiểu được những cái order chủ động là gì không? Là những order như thế nào? Các bạn có ví dụ không? Những cái order chủ động là những order thế nào? Có bạn nghĩ ra được cái gì không? Market order đúng không? Bạn Khoa nói chính xác. Tại sao nó chủ động? Không muốn đợi mua bán ngay, đúng rồi, chủ động mua, market order, mua luôn mua ngay không đợi. Và thứ hai là passive order, tức là order bị động, thì chúng ta hay nói đến limit order và có rất nhiều kiểu limit order. Đấy. Thì thường thì market order được sử dụng bởi những nhi đồng, những retail, những người chơi nhỏ. Đấy, và một điểm thứ nhất là người ta không muốn đợi, người ta muốn mua bán ngay. Và thứ hai nữa nhá, mình hỏi thử các bạn này, các bạn không care làm những cái việc trượt giá đúng không? Các bạn không care nhiều đến spread đúng không? Khi các bạn mua bán kiểu bình thường, kiểu nhá, mình hiểu là các bạn cũng có nghĩ đến việc đấy, tuy nhiên nó không phải là quan tâm lớn nhất. Đấy, cho nên khi mà các bạn không quan tâm nhiều đến spread, đúng rồi, không care trượt giá thì các bạn dùng market order. Các bạn hay dùng market order, mình xin lỗi. Đấy, đúng không ạ? Đấy thì khi mà các bạn dùng market order, các bạn lấy đi thanh khoản từ market, thế nên là nhiều khi các bạn hay thấy các cái sàn ấy, người ta hay có hai phí là phí cho maker và taker. Phí cho taker bao giờ cũng cao hơn cho maker. Từ này được viết tắt bởi market maker, tức là MM mà các bạn hay nghe mình đang ghi vào chat nhé. Và thứ hai là market taker. Market taker là những người mà người ta dùng limit order để người ta vào lại. Đấy, thì người ta dùng những cái limit order này tại vì người ta lấy đi mất cái thanh khoản. Đúng rồi, bao giờ cao hơn rất nhiều. Thì mình cứ hiểu nôm na cho các bạn là như này, các bạn cứ tưởng tượng market đây nhá, làm cái hộp, đúng không? Những người như là market maker người ta ở bên này, đây là sell nhé, đây là buy nhé, bạn cứ hiểu nôm na thế. Đây là các cái limit order chúng ta có, đúng không? Và đây là sell limit, cái này là buy limit. Các bạn cứ cảm tưởng các bạn mà dùng market order ấy, thì các bạn như là kiểu con thoi chạy trong hộp này, bắn một phát này, ăn một ít này, xuống đây bắn một phát này, ăn một ít này, ăn các bạn hiểu không? Mỗi khi các bạn hit market order buy hay sell thì bạn ăn một ít order đây, ăn một ít order đây. Những cái order này được gọi là thanh khoản. Và khi các bạn làm thế thì các bạn làm market takers, các bạn lấy mất thanh khoản. Các bạn hiểu chưa? Cái concept này rất quan trọng. Thế nên là order bao giờ cũng ăn theo đường xéo, tí nữa chúng sẽ nói rõ hơn về điều này. Đấy. Thì đấy là thứ nhất. Cái thứ hai nữa là mình muốn nói về passive order, tức là những cái order của những người chơi lớn hơn ấy, hoặc những người chơi kiên nhẫn hơn đi. Mình cứ nói như thế cho hiểu những người chơi kiên nhẫn hơn. Thì những cái order này, nếu như các bạn nghĩ về nó theo quy tắc đấu giá ấy, nó không chỉ là order mà nó còn là advertisement, nó còn là sự quảng cáo, đúng không ạ? Tức là nó quảng cáo là giá về đây thì sẽ có order nào đang đặt ở đây, willing to buy ấy, tức là người ta muốn mua, giá lên đến đây thì có ai đang chờ sẵn và người ta muốn bán. Đấy, đơn giản thì nó nó như thế. Nhưng mà cái quan trọng nhất của limit order này các bạn biết là gì không ạ? Cái limit order này thường nhá, trừ khi
So thanks, Eddie. And thanks for everybody that's joining today. Introduction to order flow. So those of you that know Jigsaw, or maybe took a look at our website after seeing the invitation, know that we sell a set of tools for reading order flow. And those tools look at order flow in the very short term. And that's not what we're going to be discussing today. So we're going to keep this within the sphere of applying order flow to day trading, but we're going to be looking a little longer term. And first of all, we're going to look at the theme or the theory or the concepts or the principles behind all order flow tools. And the goal is to remove any remaining confusion about the theories behind order flow. Now, why is this necessary? Well, I've come across many people that use one order flow tool, but really have no clue how to use others. So a good example would be someone that uses, say, cumulative delta divergences mechanically, but they're completely lost when it comes to looking at a footprint chart. So they don't fully understand the underlying theory behind the tools. So all order flow tools are simply a different view of the same information for the same reason. And it's my belief that if you understand the theory behind the tools, then that's going to make the use of the tools more productive. And we are, I'm looking at this from a complete beginner's view, as well as the view of people that just use one or two order flow tools. So after this session, you should understand mechanics of price change and be able to understand any order flow tool. Now, I know that sounds like a lofty goal, but it is true. And that doesn't mean that you'll be able to use any order flow profitably immediately. So generally speaking, order flow tools are a bit like reading a book or riding a bike. The reading a book part is because it's kind of an unfolding story, and the riding a bike part is because it takes a little practice. Now, just one thing to bear in mind, and please follow this, is we're going to discuss the merits of a number of different order flow tools, but that doesn't mean I use them all, and it doesn't mean that you should use them all. You'll end up with analysis paralysis if you try to use every order flow tool to trade on. And the other goal of this session is to actually give you actionable information that you can take away and start applying to your trading. Okay, so after this session, you will be able to take some things away and use them in your trading. Now imagine all of us have faced the conundrum in this ABCD picture here. We have a price level, the horizontal line, where we're looking to enter a trade. And of course, the market can do one of four things. It could fall short of the level, or it could, well, picture A is it reverses on our line. B, it falls short of the level and reverses. C, it pokes through the level and reverses. Or D, it just blows straight through the level. So what can you do? You could, of course, look at the level and say, okay, I'll put in an order before my level, have a really wide stop, which allows it to poke through and allows me to stay in if that happens. You could do that, but it gives you more risk. You could also scale into a trade. That works. Or you could use order flow to help identify when or if the turn is actually occurring. Now, of course, if you do use order flow in this way, it will keep you out of some good trades. But overall, the effect should be that it lowers the amount you need to risk and it keeps you out of bad trades. So that's kind of the first benefit of order flow. You can also use order flow to set a bias. And that's very, very simple. Is when the flow is biased upside, you only take long signals. And when the flow is biased downside, you only take short signals. And I'll show you how I do that later on. Another thing we can use order flow for is to define something called a second entry. Now, this is a major element to the way I trade personally. I'm like most people, I have price points I use to identify where a major reversal might take place. And I say might, because we never know. And most of the time, I don't enter at that price. I will let the market reverse, let the order flow confirm that it actually was a reversal, and then I'll look for something called a second entry, or what most people call a pullback. Now, markets do stair step, and you often get hidden backstops created once the move is underway. Those backstops that kind of stop a pullback dead may or may not be visible on the price chart, but they are mostly visible in the order flow. Now, of course, another way to use order flow is as a pure scalper. Now, I'm not a pure scalper, but every trade I enter is kind of a scalp when I first enter. I kind of enter like a scalper. And one of the key things to keep in mind about scalping is that every scalper I know still has an emphasis on trade location. So you don't start to use order flow, just look at order flow and kind of ignore everything else you know. You still need to have a way to define trade location. So people aren't just switching on their trading PCs, seeing something on the bids and offers and hitting it without considering where you are in the day and what the bigger picture is. Okay, so those are the benefits that we expect to get from order flow. But what is order flow anyway? And there's two main components to order flow. The intent is what people say they are going to do, and the actual is what actually happens, what actually trades. So those are the two main components. Now, of all the order flow tools, there's only the depth of market or the DOM that shows the intent. Now, as a position day trader or a slightly longer term day trader than the scalper, you can get away without the bids and offers. You can get away without looking at the intent. But as a scalper, you can't get away without using the intent. It is essential. Now, it's also worth noting that when the market gets into a tight range, you might have to turn yourself into a scalper to some extent if you want to play that range. And for those of you that were trading the ES through 2013, that was pretty much essential to keep building your account in 2013 because that's what the market did a lot, turned into small ranges. At that point, the actual intent becomes a lot more important than the actual at the extremes, because when you get to the extremes, it always appears that the extreme is going to break. So the use of actual trade info is what people are talking about when they use the term tape reading. So a lot of what we talk about today is going to be what is known as tape reading. Okay, and the purpose is we're trying to evaluate right here, right now, what is the market actually doing, and that's why we try to use it at a price level we've got predefined. So we have a price level where we expect something to happen, and order flow tells us is that actually happening. Now, in terms of perspective, with order flow, you don't really have the kind of concept of higher time frames and lower time frames. Although some order flow, obviously the order flow tools you can put on different charts. When we look at price action, many people look at higher time frames and lower time frame charts. But with order flow, the different tools are the thing that give you a different perspective. So for me, I would use cumulative delta to help me set bias, but I would not dream of using cumulative delta for verifying an entry. So you can put the tools on any time frame chart, but the way they actually present the information gives them their own perspective. Now, there's one thing on there that some of you might not be expecting to see on a presentation on order flow, and that is the volume. So I do believe that volume is an integral part of reading order flow, and we are going to include some looks at different ways of looking at volume as well when we look at the order flow today. So here's a question that's on everybody's mind. Why does price move? Now, different people have got different answers to this. Now, when I say why does price move, I don't mean why are people buying here or why are people selling here. That's a completely different question. I mean, why does price move around at all? Okay, why doesn't price just stay where it is? Now, some people will say price moves because there are more buyers and sellers. Now, the market it just purely exists to match buyers and sellers. So a trade cannot take place without a buyer and a seller. Now, in a way, this could have you thinking that order flow is total nonsense. Because why would you analyze a flow of orders when every buy is also a sell? Because a buy cancels out a sell, one cancels out the other, right? Okay, but it's not really more buyers and sellers. Now, some people say it's supply and demand that makes price move. Well, possibly, but it's not in the traditional sense of supply and demand. There's no scarcity for contracts in futures markets that actually get created and destroyed as trades occur. Another answer we can get why price moves, maybe more aggressive buyers and sellers. Well, that is a little bit closer to the truth. But perhaps the truth is it's less patient buyers and sellers. But the real question we should be asking ourselves, because this is the key to order flow, is what stops price from moving? Okay, so why is it that the ES doesn't trade at 1580 1 second, then 1260 the next second, then 500 the next second, then 1850 the next second? And the answer to that question, what stops price from moving, is also the key to reading order flow and understanding all order flow tools. And the key to why price moves, or why it doesn't move around all over the place, is the consumption of liquidity. Now, what is liquidity? We always hear it's a liquid market, or it's not a very liquid market. Liquidity is the availability of the other side to trade with. So if you're a buyer and you're buying at market, it's the availability of a seller to trade with. And when you trade, you're either providing or taking liquidity from the market, depending on the type of order you use. So liquidity is limit orders, it's bids and offers. And for those of you who aren't used to that terminology, it's your eyes glazing over as I talk about bids and offers in my explanation. So I'm not going to talk about bids and offers initially, because a lot of people have conceptual issues with it. They can't match a bid with buying and an offer with selling. So we're going to talk about floors and ceilings. Okay, so what we have here is a picture of a building, and it was a building designed by me, and it's got no stairs and no elevator. Okay, so imagine that this building is the market. Okay, and imagine that we're on the top floor here. Okay, now on the top floor, what we've got above us is we've got a ceiling above us, and we've got a floor below us. To move down to the next floor, what do we need to do? We need to break through the floor below us. Okay, and the market does exactly the same thing. So the floors and ceilings are limit orders, and these limit orders need to be consumed or eaten by market orders before we can move through a level. Okay, so to move down, we need to eat through the floor, and to move up, we need to eat through the ceiling. Okay, so at this point, we've eaten through a floor. Sell market orders have eaten by limit orders, and we've dropped down. Now, also at this point, is it easier for us to move down or up? Okay, so look at where we are. We have momentum downwards, but is it easier for us to move down or up here? Okay, now this isn't a trick question. Okay, it is easier for us to move up at this point because there's a bloody big hole in the ceiling. Okay, there is nothing above us to eat. The ceiling is not there. Okay, and that's another key concept of order flow. Okay. Because what will happen as the market moves down, we break through the floor, and that effectively leaves a hole in the ceiling above us that needs to be repaired, and we break through the floor, and the ceiling needs to be repaired, and we break through the floor, and the ceiling needs to be repaired. Okay? Once that ceiling is repaired, it's no longer easier to go back up than it is to go down. Okay? So that's how the market works. The market effectively has floors and ceilings, and price can't move until the floor has been consumed or the ceiling has been consumed. Right. So resting orders. Okay? The floors and ceilings, what are they? Okay, so if you've ever looked at the dome, okay, you have seen the floors and the ceilings. The bids here represent the floor, and the offers here represent the ceiling. Okay, now some people say offers and some people say asks, and I've got a horrible feeling I'm going to use those interchangeably through this webinar because I never use the same word in two consecutive sentences. Some people also call these resting orders because effectively they just sit there until somebody hits them. Now, different domes or different depths of markets show different amount of levels. This is the Ninja Dome, and it only shows 5 levels of bids and 5 levels of offers. And for those of you who are counting the numbers and say I can see 6, it's because Ninja also shows a total. Okay, on the buy side, when we look at the floors, there is liquidity below those 5 levels. There are floors all the way down here. Okay, you just can't see it because the platform doesn't display it. But there is no buy side liquidity. There is no bids. There are no floors above you. Okay, on the sell side, the ceilings here, we show the 5 ceilings. There are more ceilings above us, but you just can't see it because the platform doesn't display it. But there are no ceilings below you, which is pretty much the same when you're in a building, you look down and it's all floors. Okay, now this is important because it means that as we move upwards, we move up into areas where there are no existing floors, but where there are ceilings. Okay, when we move down into areas where there are no ceilings, but where floors do exist. And that means that when price moves, a relative liquidity vacuum, we'll call it, is created beneath you. Okay, so as we move up, a liquidity vacuum is created beneath us as we move into an area where these floors don't exist. And it takes time for the floors to build up in your wake. And the same thing on the move down. In a move down, a relative liquidity vacuum is created behind you, above you, as it takes time for the ceilings to build up behind you. And spotting those liquidity vacuums, where price pulls back because of a lack of liquidity and not because of counter trend trading, that presents opportunity. This is one of the ways you get your second entry or your pullback trade. Okay, and I'm going to show you ways to do that exactly later on. But for now, just remember, there are no floors below you and there are no ceilings above you. Sorry, there are no ceilings below you and there are no floors above you. Okay, and here is another way to imagine the liquidity picture. As you move up, bids get thinner, and as we move down, the offers get thinner. Okay, obviously, as we're moving up, bids get thinner and offers get thicker. It's going to be harder to maintain that upward momentum until these bids have had time to thicken up again. Okay, now this brings us to another important point. At an area of resistance, the ceilings are going to be really, really, really thick. If you look at the dome and you look at the numbers on the dome, the offers are going to be 1.5 to 3 times the size of the bids at an area of resistance. Now, if you're not sure whether a level that you're looking at is one that other traders see as a resistance, this will actually tell you. So if you have a level marked up on your dome where you think the market's going to turn around and it doesn't, and you don't see thickness up there, then there's not many other people looking at that level. Now, as you get to resistance, the offers are going to be stacked. But the thing is, it does not mean that that level is going to hold. Okay, and it's the same at the lows with support. The bids will be stacked at any valid support level, but again, it doesn't mean the level's going to hold. It's just the way the market works, like a phenomenon of the market, I guess you could call it. Now, very often, as price trades towards those thick floors and ceilings, and we get there, they just suddenly pull out of the way, and the level breaks. Okay, so that is actually the end of the theory. At any time, the market doesn't have a price. So if you think about the price, I mean, the ES is 1841.50 now. That is actually the last traded price. The market at any time has actually got two prices. It has a floor price and a ceiling price, which is the inside bid and the inside offer, with a minimum one tick difference between the two. And that difference obviously is known as the bid-offer spread. Okay. Now, market orders consume buy-side and sell-side liquidity, which is also known as limit orders, and which we're also going to call floors and ceilings. And when there's no more ceiling to eat, more buy market orders will start eating the next ceiling up, and price will move up with it. Okay. When there's no more floor to eat, price will move down, and we'll start eating the next floor down. And all order flow analysis is effectively simply a variation on this theme. Okay. The other thing we have to remember, as we move up, a relative liquidity vacuum builds up behind you, and price can momentarily collapse into these vacuums before continuing up. And those vacuums present short-term opportunities, and we're going to learn how to spot those soon. Now, different players work on different time horizons and take different amount of times to get their orders in and to fill those vacuums. Okay, but as that process goes through, as those vacuums fill in, that creates a line in the sand behind the move, and that is what supports price as we step up. Now, one of the things as you look at order flow, you should always keep an eye in the rear view mirror when you're using order flow. So don't just look ahead of yourself for obstacles like large offers above you or large bids below you. Also make sure you keep looking behind the move for these vacuums and for these lines in the sand that will build up and will support you as you move up. Okay, all this we're going to look at soon. Now, can I just ask at this point, does anybody have any questions about what we've covered so far? Yep, I'll carry on, and then we can also always stop for those questions in a short while. Okay. Not with the cumulative delta. I mean, in terms of spoofing and HFTs, I put very little emphasis on the bids and offers on the dome. It's probably the least important piece of information. I do use spoofing. I do look for instance, if the market's moving up and I see huge bids below me and a move up, I will expect the market to pull. But even with order flow, you're in a different space from HFT machine trading, literally to the extent where I will be watching order flow at a single level for 2 or 3 minutes to make a decision to make a trade. So it doesn't screw with cumulative delta, but that is market dependent. A market like the ES, a lot of people using market orders to enter. But anyway, we'll answer that question as we move on. Well, market orders and buy stop orders are both types of market orders, and they are both consuming liquidity. We're going to, and for the next question on volume profile, as we get to the later slides, when we're actually talking about volume at price, we're actually going to make those things a little bit clearer. Yeah, absolutely. And we're going to look at as I said, we're going to look at the volume profile later on. But also, if you look at I think somebody posted a link earlier on to the last webinar we did, Trading Without Charts. I go into a lot of detail on that in that webinar. Yep. Okay, so if we think about what we've looked at so far, big question is, well, so what? I mean, this is all theory, right? But how do we put this into action? What is the benefit of understanding this liquidity consumption model? Okay, so let's just consider a few implications of what we've gone through so far in terms of things we regularly see in the market. Okay, and one of the things we regularly see are spikes versus churns, or rapid move up versus slow grinds up. Now, lots of people are going to see a quick move up in the market, and they're going to equate that to strength. But if you consider the liquidity consumption model, if you think about floors and ceilings, we know that a rapid spike up is going to create a larger vacuum behind it. Now, on the other hand, a market that just grinds, just a few ticks, a few ticks every few minutes, is often considered weak. We all see this grinding action, but just grinds, trades, tick up, grinds, trades, tick up. That grinding action is actually a sign of strength, because the slower move doesn't have the same liquidity vacuums building behind it, because it's moving up slowly, and those vacuums have time to fill in. Now, grinding moves are also signs that the market actually likes to trade at successively higher prices, and that's price acceptance. So grinding moves can be hard to trade, because when the market grinds up, you don't get a pullback, okay? But once you understand that a grinding move is actually a sign of strength, it makes it more psychologically acceptable to just jump on board and move like that. Now, as we said, retracements or pullbacks can be spotted by a lack of participation in any counter-trend move. Okay, so the market might move down in an uptrend, but if it's because of a lack of liquidity below a vacuum, then the volume and the delta will not be significant in that pullback. Now, part of the reason that markets have a tendency to step up and down is the fact that it takes time for liquidity to fill up in the wake of a move. Now, of course, you do get perma-faders who can't stop themselves from shorting every move up and buying every move down. Intraday, everybody that has bought, every intraday trader that has bought a contract, once they're in position, they're people that have to sell to unwind. And of course, that is one of the causes of pullbacks. Okay, and sometimes when the market pulls back, there is a bit of selling, and sometimes the market actually needs to pull back to actually shake out some of these people who have bought and shake out these future sellers. Okay, so as you move up, you are gathering future sellers, and you often get to a point where you just need to offload some of those future sellers before the market continues moving up. Okay, so when we do stair step back to a point where the liquidity is filled in, we might see a little bit of selling, but we should still see a very big difference between the selling that moves up and selling that moves down. Now, we've got a feel for the theory of the order flow. So let's consider the implications of that model when it comes to reversals. Now, when I talk about reversals, I mean major reversals and minor reversals. Major reversals being the ones that initiate a new trend, and minor ones being the pullbacks. Now, based on what we know about liquidity and liquidity being consumed, we can identify just 3 elements that will cause a reversal. Now, not all reversals have all 3 elements, but all reversals have one or more of them, okay? And the market can only reverse with these 3 elements, and without them, it is impossible for the market to reverse, okay? Now, some of these elements are going to be easier to spot in the order flow than others. So let's just consider these 3 elements one by one. Now, for the sake of simplicity, I'm just going to talk about a long to short reversal and presume you can flip this around yourself from short to long. So the first element of a reversal that we may see is something called absorption, okay? Now, this is where the buying continues, but the ceiling doesn't break. The ceiling will either be too thick when we get there, or as buying eats the ceiling, we see more limit orders come in, and the ceiling is actually building up as the buying is actually consuming the ceiling. And this rebuilding of the ceiling as it's being consumed is what's known as an iceberg order. So in terms of being easy to spot, absorption is the easiest thing to spot. It's the easiest sign of a reversal to spot. One of the reasons it's easy to spot, and this kind of harks back to the HFT question, is it takes place over a decent amount of time. Now, on thicker markets, it can take many minutes for this absorption to play out. So what it means is that the offers or the ceilings or the sellers are stepping in and absorbing all the buying, and the buying is no longer able to make the market move up. And eventually what happens, the buyers give up or just run out of money, basically. In some cases, you will be able to actually join the price that the ceiling is, or the ceiling price effectively, you will be able to join the offer, okay? But that really does depend on the market. So you might see the absorption. So if maybe I see absorption on the offer at 39.25, I might see that, know that the market's not going to go up any, or suspect the market's not going to go up any further, join the offer, not get filled, and see the market go down 10 points, okay? So in some cases, you're going to be able to join the market at that point, but it is market dependent, okay? On the treasuries, yeah, when you see the absorption, joining the offer is quite often possible. On the S&Ps and thinner markets, joining the offer, generally speaking, doesn't get you filled. You're absolutely right about the trade, but usually goes away without you. Okay, so that's absorption. The second element that we may see in a reversal is buyers fading away. So this is where we get to a price and just nobody wants to trade that price, okay? Sometimes that's a gradual change. So we might get 1,000 buy market orders, it ticks up. Then 600, it ticks up. Then 300, it ticks up. Then we get to the next price, 50 trade, and we're done. Other times, you're going to have regular trading at one price, and then you tick up to another price, and there is just nobody that wants to trade it. Now, ultra-thick markets, like the treasuries, might just hit this price one time. So you go on the treasury, you might get to a price, nobody wants to trade it, and you don't get there again. The ES tends to go to that level a couple of times, okay? And each time, either no trades or just a pitiful amount of contracts trade. So don't hit into the market. Don't feel you need to hit into the market. Whatever market you trade, be aware of whether it comes back to these prices. Don't feel you need to hit into the market. You see it tick up 50 trade, it comes down, you go short. That's not really the way to do it, okay? Now, it's fairly easy to spot this, but you often don't have the luxury of time that you have with the absorption. And markets do often take a pause. So you need to be looking for the buyers fading at a key level. You shouldn't be looking for it in the middle of a trading range, okay? And there is a time element to it. It takes time for the buyers to realize that nobody else is buying anymore, okay? Once the buyers realize that, then they're going to start to unwind and you will see sellers coming, okay? Now, the third element to reversal is sellers coming in force and the market rolling over. Now, this is where you don't so much see buyers fading away as just getting to a level and suddenly sellers start hitting it aggressively with size. And many times this is going to be after the absorption, after all the buyers fading, but other times it's going to come out of the blue with no warning. Now, you'll most likely see sell market orders in total to be between 2 to 3 times the amount of buy market orders when this happens, okay? So you will see an irregular or an excessive amount of selling compared to the buying. But this is hard to spot in a timely manner. In other words, by the time you spot this, the market's going to tick down a couple of ticks, 2 or 3 ticks. Now, at that point, you can decide to get in at a, in quotes, worse price, which is effectively trading a good price for confirmation, okay? That doesn't make it a worse trade that you get at a worse price because you're actually paying for that confirmation effectively. Now, of course, sellers stepping in is also going to help you confirm a short trade after you've taken the trade, okay? So if you see the absorption at a high and you go short, then after you've gone short, you don't just forget about order flow. There's no law that says order flow can only be used for order entry, okay? Order flow is an excellent way to confirm that a trade is actually going your way. So if you go short on absorption, you're waiting to see the sellers step in. And if the sellers don't step in, then you need to think about maybe the premise of the trade wasn't that good. And similarly, it's also a good way to tell if the order flow is against you when you enter a trade, okay? So order flow, don't just think about entry. Think about entry. Think about just after your entry. Yeah, once you like, if you're in a trade on the ES and you're a position day trader, sure, once you're 2 or 3 points into profit on a trade, you don't really need to be so aggressively focused on order flow anymore. Now, just to reiterate, these 3 elements of a reversal, they're not mutually exclusive, okay? You're often going to see more than one of them, but you will always see one of them with every reversal. Okay, so what if you actually miss a major reversal? Well, as I said earlier on, for me, missing a major reversal is a good thing because I'm of the opinion that you should miss a major reversal. I meet up with a lot of retail traders, and 90% of the ones I meet that are losing are what I call perma-faders. And it's like a disease. The moment they spot the market is moving up, they're trying to short it. And then when it finally does start to reverse and move down, they start looking for a long trade. So for me, I'm fairly good at estimating where the market may be headed. But I'll usually have 3 or 4 potential areas where traders will offload and potentially start trading the other way. Okay, so I don't fade all of these levels because trading against the market is always a lower probability than trading with it. Plus, I've got 3 or 4 levels. Should I just fade each level every time, knowing that only one of them is going to work out? Now, based on what we know about price action and order flow, we can start identifying which moves are reversals and which are pullbacks and use that to set our bias and then look for a second entry. So how do you know that the last counter trend move was a reversal and not a pullback? Okay, and I think this is one of the things that you can take away today. You'll find this very useful. Okay, so the things that you're going to tell you if that was a reversal or a pullback. First, the move occurred in an area you actually expected a major reversal. Okay, that's one of the first things you look for to tell if a move is a reversal or a pullback. Secondly, the delta or the footprint accompanying the move is significant. Okay, and we'll look at how to spot this shortly. Third, the volume accompanying the move is significant, and also the number of ticks in that pullback, in that leg, in that swing is also significant. So let's say that ES, and I am an ES trader, so I don't talk about other markets when I'm doing presentations. If you look at other markets, you're going to have to figure out how to apply this yourself. But anyway, let's say the ES had moved down 8 points, and now we see an upswing with significant delta, significant volume, and a larger number of ticks in the pullbacks on the way down. And it's also in an area where we thought it might be a logical place to reverse. At this point, I personally don't have an entry, but I do have a new bias. Okay, I do now have an upward bias. So now you wait for it to drop back down and for the floor to form below you, so you can actually get in with limited risk. Then you look for the absorption, the sellers to fade away, or the bias to jump in, the three elements of a reversal. Okay, now order flow accompanying a pullback should be weak. You should see a smaller amount of delta, lower volume, lower swing size. Okay, now of course you don't know the full size of any pullback till it's over. So I'm not claiming I know how big a pullback is before the pullback's actually complete. Now these are the second entry trades. One of the things about second entry trades, if you're still a perma fader and you're always trying to take like the hero trade to fade the high and the lows of the day, the second entries, the pullbacks, do absolutely have less profit potential per contract, but they are traded in an area that is less crowded. So when a market hits a prior high, there are lots of people looking to enter there, and lots of people looking to enter a breakout long and to fade the high. Okay, and the market gets pushed around, and people get pushed out of position. If somebody wants to establish a really large position, then a major high or low is an absolutely excellent place for market manipulation, getting people to buy so you can sell to them, or getting people to sell so you can buy from them. For the minor reversals, there's a lot less people looking to trade at that point. You don't have the same sort of games being played, and the order flow is a lot easier to read just because of that. Okay, so I don't want to be too preachy with second entries, but I would like to think if you find yourself always fading moves and always getting run over, then you might want to think about just using the major moves to set your bias. Okay, now what we're going to do now, we're going to start looking through some of the tools, the most commonly used order flow tools. Yeah, absolutely. Possibly, but effectively, Bassi, if you tune in here on a Tuesday and a Thursday at it's 9:30 Central, we do it right, Eddie. We actually do that live. We actually go over Tuesday and Thursday. We take a pause in the market and we actually go through trades that are setting up based on all this stuff as well. So we can do that, but be aware I've actually been in bed tonight. I haven't traded at all today. I was in bed because of this webinar. Yeah. I don't trade news at all. I mean, I do, I have done some studies of, where liquidity is sitting, and often, you can study where liquidity is sitting and look at the market going back to those points of news events, but I just don't trade news at all. I'll wait for it to unfold and then start trading afterwards. And again, I use volume profile. I will let the volume profile build up. So if you go and look at the trading that charts video we did, you'll have a better understanding of how I do that and how I let areas build up before I trade them. Okay, so yeah, what we do. So what we're going to do now is we're going to start looking at the most commonly used order flow tools and kind of try and look at the pros and cons of each. So first of all, we're going to look at cumulative delta. And if you haven't seen that, it looks a bit like a price chart, but it shows buy market orders minus sell market orders. So buy market orders should eat the sell side liquidity, it should eat the ceilings, and price should move up. So we don't see the ceilings, but we know that they're there, right? We know that that's kind of the floors and ceilings have got to be there. Now, on the cumulative delta, absorption is characterized by the delta moving up, but the price not moving up, okay? And that is traders getting trapped. Still, the cumulative delta is a bit too zoomed out, or it's a bit too high level, in my opinion, to get a good handle on short-term absorption. So most of the time, when you see the absorption on the cumulative delta, the amount of buying that has been absorbed by the sellers is quite huge. And when you see a huge amount of absorption, the end result is usually that the ceilings get consumed and we get a nice pop up as those sellers bail out. Okay, so you do want to see sellers absorbing, but you also need the buyers to stop buying, right? Because even though the sellers are absorbing, if the buyers carry on and buy 30, 40, 50, 60,000 contracts, the sellers are not going to hold that down. And the kind of, when it becomes obvious on cumulative delta that sellers are absorbing, you're already talking 5, 6, 7, 8, 9, 10,000 contracts of absorption. Okay, and that is to the high end. Now again, buyers fading away is also a little bit less easy to see on cumulative delta because it's a zoomed out view. Sellers coming in is fairly easy to see on cumulative delta, but by the time you see it on the cumulative delta, as opposed to a short-term order flow like footprint or time and sales, the market's probably already going to have traveled quite far. So my opinion is the value of cumulative delta is in setting bias and identifying these liquidity vacuums or pullbacks. Now, very thin markets like crude oil will also fare less well with cumulative delta because the use of market versus limit orders is different on crude oil. Okay, you'll see on crude oil you're going to see long periods of the cumulative delta diverging from price because of that. So it's really not very good in a predictive sense. Okay, so this is not a particularly cherry-picked chart. I'm going to show you two charts, cumulative delta. Some of the action is going to be a little bit ugly, but then some of the action is a little bit ugly on an average day. Now, just go through what this chart is. This is a 900 tick chart. There's nothing magical about 900 ticks. I use 900 ticks personally because it shows about half a day's action on the ES. Now, if the ES slows down like a holiday period, I'd change that 900 to 600, just because the 600 would then be showing about half a day. Now, the reason I use a tick chart as opposed to a time chart, time-based chart, is the tick charts tend to show more intraday swings, and I'm more interested in the swings than the time the action occurred. Now, the white numbers here are the number of ticks in the swing, okay? The blue numbers are the number of contracts in the swing. Now, I personally don't care about individual price bars. So you can see the price bars here are kind of dull grey, but I do care about the swings. So basically what I've got here, I've just got the swings highlighted. Okay, so just to let you know how these things are coloured here, okay, you're going to get a green bar here on a swing up, okay, and by the way, this is a free indicator that's showing the swings here, it's not something I sell, okay, so the swings are going to be coloured green if there's a swing up and the number of contracts traded in the swing up is greater than the last swing down, okay, and we're also going to colour green if it's a swing down and the number of contracts traded in the swing down is less than the swing up, okay? So in other words, it stays green if the volume is to the upside, and it stays red if the volume is to the downside. Now the chart below, in the bottom half of the frame, is the cumulative delta, okay? So that kind of explains what you're seeing on the chart. So let's look at this first swing down, okay? We've got a high of around 1359 here, and we end up moving all the way down to 1348, okay? So as well as the cumulative delta, we're also going to take a look at the volume and some of the other things that we've identified as being essential to spot a reversal. So the first move down, okay, we traded 48,000 contracts, and we moved down 12 ticks, okay? Then we move up 5 ticks with 4,000 contracts of volume, okay? So that 5 tick move up is almost half the size of the move down, but it has 1/10 of the volume, okay? So that is effectively a liquidity vacuum. That is not buyers stepping in, a bunch of buyers stepping in and buying the market up, okay? Now also, if you look down at where we came off and we did the first leg down, the 12 ticks down, we can see the cumulative delta roll over, but if we look at the pullback up, the 5 tick pullback up, we can't see anything on the cumulative delta. And again, that's just indicative of the fact that there weren't really more sellers than buyers in that pullback. It was just effectively that there was no ceiling, okay? And the market just kind of got sucked back up into there, okay? If we look at the next leg down, we've got 57,000 contracts traded, and then the next pullback up, 17,000 contracts, okay? And again, look at the delta on that pullback. It's simply, there's no, we're moving sideways a little bit, but there's really no delta move there, okay? Now, it's the reversal in the delta that tells you to switch your bias. So we can see a reverse in the delta here, and we can see a reverse in the delta there. Now, on the S&P, you're normally looking for the delta to shift 10,000 or more contracts before you change your bias, okay? So you're looking for a 10,000 shift in delta reversal, and you're looking for no shift in reversal for a pullback, okay? You're looking for no shift in delta for a pullback, okay? So let's look at the upswing. We've come down, we've made a low, we've now got a high and a low today, and we push back up. So we're down at 1348, and we push back up all the way to 1358, which is 1 point below the high of the day. So it is an area that we're targeting, and effectively what we're seeing here, we're seeing it falling short of the high of the day. So as we move up there, we can see a huge push up in the volume, in the delta. We can also see with that swing up, we've got a huge amount of volume in the swing up, and we can see the swing size 31 ticks is fairly big. Now, there really isn't much of an opportunity to get on board a second entry, okay? Not based on the chart. There's no pullback, okay? Although there is something called a volume cluster in the middle, and we're going to talk about that a little bit later. This first pullback here doesn't actually look like it's much of an opportunity because, you know, eventually the market doesn't go that high, and we are quite close to the high of the day, okay? But it's clear, if you look down here, that the delta doesn't shift down, and also the volume isn't supporting that as a reversal down, okay? And now we're going to look at the move down from 1358 to 4750. Now notice in this case we do have the added confirmation up here that we are reversing off a known area, okay? So this is a failed attempt at the high of the day, okay? And we start off with a 70,000 push down, and we start off with 19 ticks. So we can see with that leg down, we've got a lot of volume and a lot of ticks, okay? Then it retraces over half that move with a lot less volume, and again, if you look down the delta barely moves, okay? And as we move down through the daily low, all the way down here, we can see the downswings with more volume and ticks and delta than the upswings, okay? Now, from 4750, as we get to 4750 here, we start up this move to 1351, okay? And looking at the chart, you have to say, looking at the chart, that looks like the market bottoming out. It does look like a reversal. But if you look down at the delta, is the delta shifting up considerably there? Do we have a significant amount of volume in these swings up? Do we have a significant amount of size in ticks in one of the swings up? And right now you have to say no. So at this point, okay, it could be reversal, but at this point, the order flow is really not telling us that this market is reversed. Okay. And this is how it played out. Basically, we had another leg down to 45 and eventually reversed up. Now, this is where it gets kind of ugly, okay? Because really, this area here, we don't know it's reversal until, perhaps this area here when we're about 1349, okay? So in this case, what we've got, when we go to 45, we've got a case where we've got a low of the day and we've actually overshot the low of the day, and now we were reversing back through what the low of the day was, okay? So we failed to get to the daily high, but we shot through the daily low. Now, on this reversal up, we don't really have a big shift in the delta until we get to this point, the move up to 1349. At that point, the delta's up about 15,000 contracts. Then that is also the first point where we see the delta and the volume in the swing and the swing size confirming a move up. Now, if we look at the pullbacks, we can see that the pullbacks are kind of, they are lower in size. We don't have the delta. You might have got wiggled out in this area here. You've got your first pullback there. If you were very tight with your stop, you've got wiggled out in your trade. But you see that generally speaking, as we move up, the volume is on the upside, the size of the swing is on the upside, the delta is on the upside. Okay, and basically that is how I use cumulative delta. That is what I think the best use of cumulative delta is. Okay, so I think cumulative delta is good for longer term order flow. You could look at this and say, well, look, he's using that on a 900 tick chart. Why don't I put that on a 50 tick chart? And then I can use cumulative delta as a short term order flow tool. Okay, but to me, that still wouldn't make the delta a good short term order flow tool. And obviously, I've tried that, and it just doesn't work well because I think the nature of the cumulative delta is that it's a zoomed out tool. Now, the other thing about cumulative delta, and I'll probably get shot for saying this, it is a good hindsight tool. Okay, now unlike some of the order flow tools, the cumulative delta is going to look the same in hindsight as it does in real time. Okay, so if you actually want to start using cumulative delta, you can load up historical cumulative delta charts, look at the history of how this thing played out, and then start to incorporate that into your methods. With things like the footprint charts, volume profile, you simply can't do that. Okay, so that's one of the benefits of cumulative delta. Okay, so footprint charts, I'm going to say same information, different format. So footprint charts show trades at the bid next to trades at the offer. Okay, so whereas cumulative delta is showing you the difference between the two, footprint charts kind of requires you to work out what the difference is. Now, this is a more zoomed in view, but of course you can put a footprint on a longer term chart. Now, if we're looking for absorption on the footprint, we're going to see a large volume of contracts trading into a price without it being able to move through. And usually that's going to occur at just one or two prices on a thicker market like the ES. We're going to see buyers fade simply by seeing no contracts or very few contracts printing at price. And sellers coming in, we're going to see price move down and approximately 1.5 to 3 times the size on the sell side to the buy side. Now, in terms of footprint charts, a footprint chart sits on top of a bar chart effectively. So if you can do it, you can do a footprint chart on a 5-minute chart, 15-minute chart, 1-hour chart. If you're going to look at footprint charts, I would say, for various reasons, you should use range charts or point and figure charts. And the reason for that is because we tend to basically, with a footprint chart, we'll go up and we'll come down, and with a reversal, with a chart that shows reversal like a range chart, you'll see the move up on one bar and the move down on another bar. If you use a time-based chart, you're going to see the move up and the move down all in one bar. So effectively, the footprint chart is going to overwrite or add to existing information. So you're not going to be able to say, okay, what happened on the way up, what happened on the way down. So range chart, like a 5-range chart on the ES, a 10-range chart on the crude oil, or point and figure charts, they're the ones that work best with footprint charts because they effectively show you the swings. Okay. So here's a footprint chart, and as you can see, we have pairs of numbers with red and green background. So each pair, the numbers on the left with the red background are sell market orders, and the numbers on the right are the buy market orders. Now, we've also got the delta at the bottom here in 2 formats. Now, once again, the delta is the buy market orders minus the sell market orders, but specific to all of the trading in this bar here. Okay. Now, first of all, what we'll do, let's just take a look at what's happened here. Okay. So what we can see, we've had a move up, and if we look at the move up, at the bottom we've got some size, but on the move up, we've generally seen it's been maxing out at 2,000 to 3,000 contracts at each level. When we get up here to where the red arrows are, 4275, we see absorption on the upper side. So we see this 5,000, nearly 8,000 contracts on the upper side. Okay, and that is absorption. And now, obviously, what you can say looking at that, yeah, but look at the bid, look at the bid side, 4,000, 6,000, 8,000 on the bid. Isn't that absorption too? And the answer is well, sort of, but there's 2 caveats you've got to kind of consider with the footprint chart. The first of all is there is always two-sided trading. So whenever there is absorption on the ceiling, whenever the ceilings are absorbing, the buyers don't just stop buying at the same time. So you're going to move up, and you will see absorption, a lot of trades at the offer. But while that's occurring, you're still going to see trades at the bid, which is one of the reasons you get size on both sides. Okay. But the other thing is, as we reverse down, okay, you're going to see the sellers jump in size, and that's going to appear on the left side, on the bid side. Okay. And that's going to add to whatever quantity was made on the way up. So what you're seeing here on this bar here, you're seeing the move up and the move down. Okay, and that's one of the problems with footprint charts looking back historically, is you don't get a good handle on what was in the move up, what stopped it, and then what happened on the move down, because it kind of overwrites it. Now the white boxes here represent the close of the bar. So we can see 997 at the top of the last bar, and we can see that we traded down to 181 and closed this bar. Okay, so from this bar here, we only actually managed another 2 ticks up. Okay, and that's what tips us off. So that tips off where this bar closed is a reason we can fairly confidently say there was absorption here, and then we built volume back on the way down. Okay, so it's not a guarantee, but if you're actually looking at footprints historically, look at where the bars closed. Okay, now let's take a look at the white arrows. Okay, so we can see that we peaked up here and we just printed 44 contracts. There's no buyers there. Now it just probably just slipped through momentarily. If we had absorption here on the offer side, what you'll find is sometimes there's absorption and they're rebuilding the ceilings and rebuilding the ceilings and rebuilding the ceilings. But sometimes the buyer just momentarily breaks through the ceiling and then they add to the ceiling again, and it just gets whacked down. So we can't say at this point categorically that it moved up to there and the buyers faded away, as opposed to we just managed to peak up for a minute because they couldn't rebuild the ceilings fast enough. But over to the right hand side, that is buyers fading away. Okay, so this is the point where we got up, we traded 593 contracts here, but there's no sign of absorption, right? We've just got regular trading at the price below. So we can see we got up there, and we probably went up and down there a couple of times, but there was only 593 contracts worth of trades there. There's no buyers there. We're also coming back to the high of the day, okay? So it's a point where we expect a reversal. Nobody wants to buy into that price. That is the buyers fading away, okay? And this is also the point where the seller steps in. So if you see the orange arrow pointing at the delta down here, as we moved up, we can see we're getting decent positive delta all the way up, okay? Up to this 4286 over here on the last bar of the move up. All of the buyers up to this point are obviously people that are going to need to sell to unwind their positions if they're still in. Some of them are going to be longer term traders, but generally speaking, we don't care about longer term traders when we're day trading. So as we move from left to right, we're gathering future sellers, but we're just waiting for when are they actually going to turn into sellers? What's going to trigger them to sell? As we get that second attempt to the high, as we move kind of sideways here, okay, we can see now minus 266 is pretty neutral on the delta, minus 1,000 and then plus 1,000. Well, those two kind of cancel each other out. Minus 796, minus 1946 on this bar with the right hand side white arrow. It's at this point when buyers fade that you then start to see a lot more size on the sell side, and we start to see the delta actually going negative. Okay, so there's a couple of places you could have hit into the market here. Okay, you could have hit into the market. An aggressive trade would be to fade the absorption first time to the high. Excuse me. Okay, sorry about that. So that is your first area to potentially enter a short trade. We could have taken a short trade when we had the additional confirmation of coming back to the high, when buyers have got no interest at this double top, or we could have got in when we saw this delta go negative, when we actually saw the sellers coming down here and start to push the delta negative. So that's kind of how you can use that. And you should be able to get a feel how you can play aggressively with an early entry and less aggressively based on the footprint chart, based on the flow of other traders. Okay. Now this is a slightly different type of reversal. So what we're looking at here is a move up and then a trading range that took almost an hour to resolve. So if we look at the orange arrows here, we can see that up to this 1, 2, third bar, we had fairly decent volume hitting into the bid, but on the fourth bar, it's gone. The buyers disappeared. Okay, sorry, this side here. The buyers disappeared. Okay, let me just say that again. On the move up, we had good volume actually on both sides, but in this third bar, we've got the volume effectively disappearing. And then we saw 287 contracts trade at the high. Okay. Then a few minutes later, 49 contracts trade at the high. There are simply no buyers at this point in time interested in trading those prices. Okay. Now, if we look at the red arrows, we can see that we pushed up to one tick below the high and printed 177 contracts. Again, no buyers there. Now, I can't say what happened first, okay? But I'm going to take a guess and say that this red arrow, okay, this 5,328 contracts, trying to eat the floor was an attempt to hold the market up, which failed, okay? And I say it just because, I've read a lot of the footprint charts, and that's what I'm guessing happened. I'm guessing that as we came up, we came back down here, and the bidders, the floors firmed up, a lot of contracts traded, and then they just let it go. Now, after that failed attempt, okay, the market broke downside. So what we've got is a failure to get to the high, looks like a failed attempt to hold it, and then the market breaks downside. We can see in the last two bars, the delta starts to get a lot more bearish as the sellers stepped in and started to push the market down. And of course, the buyers get out of the way because they realize that they're toast effectively. Now, in this example, where we do have sellers stepping in, this is a trading range, and it's not a huge range, okay? So you've got to use your discretion a little bit here, okay? So should you fade the top of the range when you see the buyers aren't interested, or should you wait for the sellers to step in? Because if you wait for the sellers to step in, you're potentially going to be shorting in the middle of this range, okay? So when you start to look at order flow, yeah, it's great to see sellers step in, and it's great to have that additional confirmation, but you can't just put good trade location to one side because you're using order flow. You do have to combine this with actually entering in a decent place. So in this case, I would actually say seeing the sellers step in here isn't a good trade. It is extra confirmation, but you're still getting in the middle of the trading range, and there's nothing to say you're guaranteed that the range will break. Now, we're going to cover the footprint a lot more in the second webinar we do, but for now, we can see that it's showing the same information as a cumulative delta. But the issue with footprints is they're just not as useful historically, because we might go over fresh ground as we move up, but on the way down, we're going to add to existing footprints that were created on the way up. And so we're going to kind of see the final result rather than how it developed over time. So the footprint is quite unique in that it's actually a tool, an order flow tool, that's easier to read in real time than it is in hindsight. Okay, so the next order flow tool, the order book, okay? Now, the main difference between the order book and the delta and the footprint chart is that the order book actually displays the intent. It displays the floors and ceilings. It displays the limit orders. The cumulative delta don't display the floors and ceilings, but it's merely implied how thick a market was by that price delta relationship. If the delta moves up and price doesn't move up, you know that the ceiling was thick. Okay, you know that there was more liquidity eaten on the way up. Now, decent order books like Xtrader, CQG, and of course Jigsaw will show you the trades that are executed. Now, any DOM that doesn't show you or give you a good view of actual trade execution might be a good order entry tool, but you won't find it a good order flow tool. Let's just bring across a DOM. Okay. So here's the Jigsaw trading DOM. Okay, and what we can see here, just center that. The columns here, where my cursor is, that's actually the trades actually occurring in the center. So we've got trades at the bid here, where we see the 31 little pink one. Those are the trades that are eating the floor, and the green 55 here, those are the trades that are eating the ceiling. Okay. Now, a lot of people say the depth of market is useless because of the amount of manipulation that goes on. And it is true that the market depth is manipulated with people putting in really large bids and offers and making the floors and ceilings look really thicker than they are, but that doesn't make the DOM useless, okay? So if you think about it, why would somebody go to the trouble and risk of putting in orders that they don't want to fill, okay? Because you can't put this guy down here with 1,500 contracts, whether he's fake or not. If he's spoofing, right, he actually has to have the account size to put in 1,500 contracts. Now, of course, it's not all one guy, okay? But if he's spoofing, the market comes down and he doesn't get out fast enough, he has to honor those contracts. He has to buy those contracts. So there is a lot of risk to spoofing. And the reason that they spoof the market is because that spoofing, that manipulation pays off. And that's effectively why this information is useful, because people are playing games with it, and you can watch and play the games, and you can use that information in your trading. Now, obviously, what we can see here in this blue column are the floors, and what we can see in the red column are the ceilings. Okay. In terms of manipulation, we can actually see in the outer blue and red columns, the pulling the stacking activity in what we call a snapshot. Now, this is kind of neat to watch. So I can see basically they've added, at 1837, they've added just over 230 contracts right now. Okay. But the thing is, you can get kind of caught up in all of this pulling and stacking activity. The most important information, even when you're looking at the DOM, is the trades that are actually executing at each level. Now, the DOM is very much a right here, right now tool. Okay, so it's most beneficial at refining an entry or assessing if a trade is on side just after you've entered. Okay, there's very little history on the DOM. Okay, you see what's happening right now. Now, to the outside here, we do have a volume profile, and that is actually showing us history for the whole day. And here we do have a kind of split volume profile, which effectively is similar information that you see in a footprint, telling you how many trades hit at the bid here and how many trades hit at the offer here. Okay. Now, with all these different profiles and all these different numbers, there's a lot of numbers on the screen. And one of the issues that people have is they say, I can't read the DOM. There's too many numbers on it. It moves around too much. Now, I would agree that it would be very difficult to read all of those numbers at the same time. And you don't actually need to, okay? So the mistake that people make when they start to look at the DOM is they try and read the whole screen. I don't think there's many human beings that can do that, okay? So you don't need to look at all the information all the time. So for instance, the volume profile helps you to see where other traders are currently positioned. And knowing where other traders are positioned, that gives you a trade location. Then the ebb and flow of the orders being executed gives you an idea if the market is actually holding in that trade location or actually powering through it. Then at the point you decide to say, I'm going to go long, excuse me. Sorry about that. If you want to go long, then you might decide, okay, I'm going to go long because I'm in a location. I can see that the order flow here is telling me that it might be good for a long trade. So now what I'm going to do, I'm going to look at the offers and I'm going to say, okay, I've got 700 offered there. I'm not going to go long into that until it drops down to 300, until it looks like the offer's about to break. Okay, so you never have to look at all of the information at the same time. And in fact, what many people will do, they'll actually switch off a lot of the columns, okay? But the mistake when you're using the DOM is to try and use everything at the same time, okay? So it's not about being able to process hundreds of numbers all at one time. Now, in terms of the elements of reversal, okay, absorption is very easy to spot. You'll see a lot of contracts hitting into a level, and if we look at this here, as it moves down, we can see, on average, we've got 300, 150, 600, we've got 2,000 here, contracts that hit into the bid. So we can say, okay, 2,000 is a high end, 1,300 is still decent. So if we're looking for absorption now, we'd probably be looking for 3,000 contracts or more to hit into an offer or a bid and price not moving, okay? Now, at the same time, when you're looking for absorption, you're probably also going to see some high numbers here, which is the column that tells us they're actually adding more orders, okay? Now, buyers fading, you're often going to get to a point where just a few contracts hit, okay? And you're probably going to revisit that point several times. So the things that you're going to see on here is you're going to see we get to a price, nobody trades, and then it moves up. Comes back to the price, nobody trades, and then it moves up. But there's a pause, okay? As this occurs, you're going to see it gets, and there's a pause. It doesn't start moving away straight away, okay? So for instance, we've just seen 28 contracts here, okay? If this is buyers fading away, we'll see it come back, and there'll be a pause. And when the reason there's a pause, it's as if it's palpable, the dawning of realization on behalf of those last sellers that they're the ones left holding the bag, okay? So when you see buyers fade, okay, or sellers fade, you can see if it comes down again and just a few contracts trade, all of the other sellers are going to see that, and eventually they just bail and move out of the way. Okay. Now, in terms of seeing the other side jump in, very similar to the front footprint, you're going to see the market move down to an area, and then suddenly you're going to see some large size hit into here. And the reason you're actually going to see the large size is these ceilings here won't have a chance to get in the way. So if buyers jumped in right now, you could expect to trade like 500 at this level, 1300 at this level, 1200 at this level, because they'll just come in and whack it. And even if these guys here with like 1300, 1200 contracts, even if they're not real, they just won't have time to get out of the way if buyers jump in. Now, if order flow is the icing on the cake, then the manipulation, the pulling on the stacking, could perhaps be called as the icing on top of the icing on the cake. Okay, so we can see now, average depth on the first couple of levels is below 1,000. Everywhere else is about 1,000. We've got this level here at 1834, where we've got like 1,500 contracts. But we said at any support level, we're going to see the bids higher than the offer. So when we see that large size there, that doesn't mean they're going to hold the market, and you can't read too much into it. Now, if we were moving up, say nobody, say the buyer, this is a reversal. The sellers realize nobody else is going to sell now, and we start to move up, and we move up 3, 4, 5, 6 ticks, and then suddenly on the bids below us, we see 3,000, 4,000, 5,000, that kind of size below us, okay? That absolutely screams manipulation, right? Manipulation on the DOM, stacking on the DOM, isn't having an average of 1,000 contracts and somebody putting 1,050, right? They want you to see a big number. So if you're not sure if it's spoofing, then it isn't, okay? But if you see it move up 5 or 6 ticks and then you see 3,000, 3,000, 3,000 right behind you, very likely in the market, if just in the very short term, it's very likely the market's going to actually move down. Because what you'll see is as the market moves up, if you see huge stacked orders below you, then the chances are the market's going to collapse because they're fake, and that's just some guys who are trying to exit a position, and they're trying to exit a position by stacking the bids, getting you to buy, leaning on those bids, and you're buying off them because they're actually the ceiling, okay? And when they're done, they'll pull those bids, and the market will drop down, okay? But I would say, if you're using order flow, you could quite easily use order flow without ever having worried about bids and offers, okay? It is optional. And I'll just show you one more way of actually looking at the same information. This is still short-term information, but just for a bit of fun. These meters here are also another way of seeing order flow. So the left-hand side is showing you the trades at bids and offer, which is effectively the central columns. The middle one is showing you the depth, the actual bids and offers. It's just showing the first 3 levels. And the one to the right here is showing you the changes to the depth. Okay, and again, it's just another way to look at order flow, just another way to look at DOM information. It is also very, very, very short-term. Okay, there is no history with this. It's right here, right now. Okay, so we have one more order flow tool to look at. Now, with all the order flow tools we've looked at so far, they've got one thing in common, right? They might show the sum total of the trades on each side, but none of them show the individual size of the trades themselves. Now, with the time and sales, you see the individual trades. and you also get a great feel for the pace of the market. And like the DOM, it is a right here, right now, ultra short-term order flow tool. This is not something you're going to use to analyze the overall state of the market and tell what's going to happen in the next 3 days. Okay, this is confirming an entry and confirming the order flow is on your side after the entry. Okay, and the premise is, if you see 1,000 contracts trade, would it not be nice to know if that was 5 200 lot trades or 500 2-lot trades? Because personally, I'd rather trade with 5 200 lot traders than with 500 2-lot traders. Okay, which brings us to a small problem with a lot of time and sales products. And that is in October 2009, the smart programmers at the CME, and kind of by extension, all of the exchanges that the CME owns, such as NYMEX and CBOT, decided to change the time and sales. Now, prior to these changes, if somebody submitted a 1,000 lot order, then it would show up as a 1,000 lot order on time and sales. Then the CME, in their infinite wisdom, decided to change that. So it reports 1 trade per limit order that's filled against. So if someone submits a 1,000 lot trade and it gets filled against 500 2-lot limit orders, you're going to see 500 lines on the time and sales, or rather, you would see 500 lot trades, 500 trades if you had a 19-inch trading screen. Okay, what you'll actually see is a flood of trades, pages and pages of trades going by that you can't read, and it is actually fairly useless. Now, what we did at Jigsaw, and what a few other people have done as well, there's various methods of aggregating time and sales. Now, at Jigsaw, the approach we took is to actually reverse engineer the October 2009 changes, and so we try and show the actual 1,000 lot order that was submitted. Okay, and we're with the CME market, we're about 95% right. Okay, so what about the 3 elements of reversal? And let's just bring across the time and sales. Okay, and this is time and sales. There's 2 time and sales here. One is showing all trades, one is showing just the large trades. Now, one of the things about time and sales, it actually shows the time of the trade, and it shows the full price. If you've got an option, you don't really need the time of the trade. If you're seeing trades go past at 100 miles an hour and it slows to 1 trade a minute, that's something very interesting. But you're going to see that just in the pace of the time and sales. So I would advise not showing too much information on the time and sales. All you really need to know is the price and the number of contracts. Now, on this particular time and sales, the price is actually 1834.75, but we actually I like to actually kind of chop off the first 2 digits again just to make it easier to read. So what are we going to see in terms of 3 elements of a reversal? Okay, so the first element of reversal is absorption. And with absorption, you're going to see a stream of prints, mostly on one side. Okay, and so let's talk about absorption on the ceiling, on the limit order, on the offer side, where we've got buy market orders buying into the offer. Okay, so we're going to see prints, green prints, and we're going to see all those prints at the same price. Okay, so we see buy market orders, but the price not changing. Now, obviously, what's going to happen is you're still going to get some red prints. But as the absorption, as we're moving up, we're going to have overall, in the not move, you're going to have overall more green than red, and you're going to see that green continue, but the price will just keep printing at the same price. So that's the absorption. Now, the buy is fading. Up to a point as you move up, you're going to see mostly green. Okay, it will always be a mix, but it will be mostly green in the move up. And then suddenly, the green prints stop coming. Now, you might print green again as the price comes down, but you'll see that there is a clear maximum green price. Okay, there's a maximum price that green will print at. Okay, and you'll get up to that price. Green might print a couple of contracts, but you'll only get red printing at the price below. And those that printed at the maximum price are the ones trapped in bad positions that help them move down. Now, the other thing is, don't expect only little guys to get trapped. Okay. Now, the other sign of a reversal is sellers stepping in. Well, that's pretty easy. We'll be moving up with mostly green, and then we're going to see a sudden rush of red prints with prices moving down as a result. Okay, it's not enough to just see the red, because when sellers step in, they could get trapped. Okay, so you need to see the selling come in and price progression downwards. Okay, so just seeing sellers step in is if you see sellers coming in, lots of red prints, but price doesn't move down, that's brilliant in terms of getting an entry price, because you see the willing on behalf of the sellers, you see they're willing to come in, but if they're not getting any price move down, it's just too dangerous to enter on that, because if there's no price progression downwards, sure, you've got confirmation that sellers are there, but you've also got the bid side absorbing, you've also got the floors refreshing. Okay, the time and sales has got the least history of any order flow tool. Okay, it's as much about pace as anything else. It's not everybody's cup of tea. Okay, but what I will give you is probably the best use of the time and sales for a beginner. Okay, so the best use of time and sales for a beginner is just this. It's just the large trades. Okay, so on the ES, I would recommend that you take a tape showing contracts of 100 lots or more. Okay, and what you're going to look for is as you move up, you're going to occasionally see groups of large green prints. Okay, so in a move up, like we're doing now, in a move up, you're not going to see big prints every price. Okay, you're going to see like 100, 100, 100. And then, okay, we've ticked up, okay, 36.50. And then you'll see some more big ones come in and we'll move up. And then some more big ones come in and we'll move up. And what you'll see after a while, okay, in fact, what we can see right now is that we can see we've got these large traders here, 486 at 36, all the way up to 36.50. And those large traders right now have not got anything for their money, okay? And this is one of the things, if you combine with a good trade location, that you want to look out for, because you should see large prints move up, large prints move up, large prints move up. And then when you get the large prints and no tick up, okay, and then this pause, which you can see now, is those sellers, okay, some of those buyers will be short-term buyers, okay? And there's a pause. And it's sinking into these guys that they possibly just bought a short-term high, okay? So after large prints, no move up, a pause, which can be 1 or 2 minutes, you're going to see suddenly the other side's going to come in and back the price down, okay? Now that doesn't mean you do this in the middle of the market. It doesn't mean you do this in the middle of the trading range. You still need to do this at an extreme. But actually what we're seeing now is exactly what you'd want to see for a short trade based on buyers being trapped, okay? And I'm going to leave that up there just to see how it plays out. Now, what I wanted to do was I wanted to actually talk some more about volume profiles and volume clusters. But I've taken up a lot of time right now. We will run out of time if I go on to talk about volume clusters. So what I'm going to do is I'm actually going to record for you a short 30-minute video on volume profile, on volume clusters, because I think that does complete the picture and it does answer one of the questions. But for now, let's bring it to a close. We've covered a lot of material today, but I hope the message of liquidity consumption floors and ceilings helps you to understand what order flow is all about and what is common between all these tools. Now, order flow does require a lot of discretion. It's a discretionary tool, okay? It's like reading a story, okay? It doesn't mean you trade it without rules. It just means that every situation is going to be a little bit different, but the overall patterns will be recognizable with practice. So with that, let's end there. I'll get you the other video. And Eddie, do you want to do some more questions? Yeah, I appreciate that as well. Thanks, guys. Absolutely. I use market profile. I actually have a blog on Top Step where I put my pre-market prep every day and say what I think is going to happen to the market. I absolutely use market profile for longer term analysis, and I use a lot of market profile for setting the levels I'm going to trade off intraday. I tend not to use the market profile itself intraday, but what I do use is auction market theory for trading ranges. And actually that was what if I hadn't run over so much today, that was effectively what I wanted to talk about next. It's what we talked about in the last webinar, trading without charts. But I'm going to do a video on that effectively what happens, how the market moves in terms of ranging and then trending ranging behavior intraday. But that is all part of market auction theory. So I hope that answers it. My state, I'm not sure what you mean by my state. I do absolutely do that. I tend to not worry about that so much at entry time, but I do worry about it when I'm in a trade. And by that I mean, if you want to look at an ideal place where people are getting ripped off on the market, you have a trading range, you go to the top of the trading range, and sellers start to fade the top of the trading range, and you come down, and the bids are stacked. The offers are stacked. It looks really weak, but there's iceberging. You get 2 or 3 ticks down off the top of the range, and there's an iceberg order absorbing contracts. Then they pull that iceberg order, it ticks down again, but they start absorbing there. And what's happening is they're making the market look weak, but they're absorbing all the contracts by buying, and then they move it up. Now I can see that. And if I'm on the wrong side of that, I will exit. But I don't enter trades. I don't join the manipulators. I'm not comfortable doing that. So I kind of I'm aware of it, but I don't join in with it basically. Yeah, I call it the icing on the cake. So the cake is whatever method you use to define a trade location. That could be with charts or without charts. And then the order flow is basically let you see, okay, right here, right now, at this location, am I seeing behavior which is indicative of a reversal or a continuation depending on how I trade? So I agree that scalpers, I've never heard of a scalper that doesn't use order flow, but I know a lot of position day traders that use order flow as a confirmation tool. No, it's in webinars 2 and 3. This was just an introduction. I know there's a lot covered, but this was just the introduction. So we do more specific in the other webinars. Yeah. No, we've done all the heavy lifting in this one basically. Yeah. I think Kaj has got one. Kaj 15 has got a question. Okay, he's asking if there's a platform that shows order flow plus implied volatility. I don't know. I don't use that myself, so I don't know. In general, that's kind of proprietary information. Everybody wants to figure out how we're doing that, but I'm not going to tell anybody. I think we've got one next Friday, I believe. Yeah. Yeah. Yeah, right. I think we got one more question from Zed. Okay, and I got a message on the PM as well. Yeah, that's something called Gomi Tools, which is available on the Big Mike Trading Forum. He's got an elite section over on the forum with a lot of free downloadable tools, and that's what I'm using basically. Excellent. Well, thanks guys. Thanks for coming, and I'll speak to some of you on Tuesday when we do our session then. Will do. You too. Bye. Hi, this is part 2 of our introduction to order flow webinar. Now, all of the things that we've looked at so far is the flow of orders, and that's order flow. And what we're going to look at now, I guess, could be termed as order flu or a look at where people are positioned right now. Now, there's lots of people out there that discuss the long-term use of volume profile, looking at daily, weekly, monthly profiles. FT71 is probably the most famous. L2ST have a lot of free material on volume profiling. Now, we're not going to look at long-term volume profiling today, and also we're not going to go over the ground covered in our day trading without charts webinar. We're going to look at some shorter-term volume profiling theory and a few techniques you can use. Now, the volume profile itself simply shows the quantity traded at each price for the current session. A volume cluster is simply an area, a small area, where an exceptional amount of volume traded. Now, a volume cluster, it's not dissimilar to a high volume node on a long-term volume profile, but the clusters are usually referring to action that occurs over a much shorter period of time. And I think it's important to distinguish between your approach for volume clusters and long-term volume profile, high volume areas, because you're going to be approaching them in slightly different ways. One of the most common times you're going to see a volume cluster is at a swing high or a swing low. And by that, I mean a major high and a low. On the ES, for instance, we have 10 points up, 10 points down very often on days. So we're actually talking about a volume cluster at the low of the day or the high of the day before we turn around and put in a new intraday trend. A volume cluster at a major swing low is effectively by those buyers. Now, in practice, you can't rely on the market actually coming back and testing that area. The first leg up off the bottom on the ES is often 16 or so ticks, and those areas don't actually get retested that often when we put a major swing up off the low. On a smaller first move up, then yeah, if we move up 8 ticks off the low, then we're obviously a lot more likely to see a retest, a double bottom, that kind of thing. Now, the volume cluster, most of the time, is not going to be visible on the price chart. Of course, you're going to see that the market turned around, but you're not going to see on the price chart that it turned around after printing high volume. Now, the places that this is most visible are the volume profiles and the footprint charts. Cumulative delta itself isn't going to help you a lot in terms of seeing this volume cluster there. Now, this is an area where we can have a reasonable expectation that the market will hold because of the positions held there. It's just a lower probability that will actually come back for a test. Now, what's a higher probability is a volume cluster that's created midway through a move. And here we see an example where a volume cluster might be created midway through a move. It doesn't stop the market carries on up. Now, volume clusters must be exceptional volume, and it's exceptional volume relative to what's printing that day. So if you see 10,000 contracts go off at a price, and all the levels that day have traded 9,000 contracts, it's not significant. Now, a cluster midway through a swing is usually, and probably obviously, accompanied by a pause. Because if an exceptional amount of volume is printing, it's obviously going to take time for that to happen. So when you see a market move up, then exceptional volume print, and then carry on up, you don't actually know why that happened. Now, it could be a failed attempt by bears to hold the market down, or it could just be one half of a large static position being executed. Now, if it was an attempt to hold by the bears, then those people are not going to be looking at building a short position again anytime soon. So if the bears try to hold the market down at this point, and we move away, those guys are going to get stopped out. So if we come back to those prices, they're probably not going to be in a hurry to short those same prices again. Now, other shorts, maybe the shorts that sat through the move up and saw the price come back down to where a lot of people entered, they're going to actually exit the market at that point. And if you're not sure whether that's really the case or you don't know if you should believe that, think about it yourself. Think about how many times you've gone short, seen the market move up, and then breathed a sigh of relief when the market came down to your entry point and you scratch a trade. Okay? And it's when people scratch those trades that actually helps fuel the move back up. Now, on top of this, you're going to have people who went long in this area, who built positions at the cluster, and they're going to defend that area. So it all adds up to it being an interesting place to enter the market long if the market comes back to that spot, which is more likely because it occurred midway through a swing and not right at the bottom like a low of the day. Now, certainly on the ES, price has a tendency to retest the top of these mid-swing clusters much more often than it will try to test a cluster at a swing low. Now, here we see a lot of volume trading at the low of the day. Now, even though there's a lot of volume there, we've got 7,000 contracts here, 5,000 here, 2,000, 5,000, 4,000. The delta itself is quite neutral. We've got minus 3,000, plus 1,400, plus 2,200, minus 510. So if you were watching the delta for clues of what was going on, it wouldn't really be giving you much of a clue. The delta actually only starts building as we move away from the low. And that's where the delta starts giving us some confirmation in terms of a bias, a long bias. But otherwise, looking at the delta, you really wouldn't have a clue that exceptional volume had traded in this area. Now, it would be great after this move up to come back to this high volume cluster and test it again, because we know that the people that went short in this area got burned and probably won't be in a hurry to short again. Now, as we move up, we can see that around this 8450 mark, we see the first mid-swing volume cluster. Now, note how the volume at all the other levels after we kind of broke the range is a lot lower. Okay, this is exceptional volume, 5,000, 6,000 here. There's nothing close to that as we've moved up. Now, was this somebody trying to hold the market? Was this somebody exiting a position? Is it stat arb, orders being executed? Well, we don't know, but what we do know is that as we moved away, we built a lot of positive delta. That means we have delta confirming an upward bias. And because of this midpoint cluster, there's a chance that this area will be defended if price comes back here. Now, also on top of this, the downside on any trade leaning on this area is fairly limited. If price breaks down through the high volume, your premise is invalidated. And really, at this point in time, there is no real limit to the upside. So you have a very, very good risk-reward opportunity by taking a long off the top of this volume profile, or volume cluster, sorry. And this is how it played out. We've got our initial volume cluster here. We've moved up 7 ticks. And if we look at the overall move, from the low of the day up to this point is a 6.5 point move. And most people who've been watching the ES for any length of time will tell you that an 8 tick pullback is quite normal. So as well as, in fact, we've moved up 7 ticks from here, as well as the order flow or the volume cluster being a good place to come back to, also in terms of price action, we're around the area where coming back to this area would actually be a 7 tick pullback, which is not far off what an average pullback is on the ES. So as we come down, our expectation should not be that we're going to have a retest of all this volume we're putting down here, but that we'll probably stop at this point. Now we can see that as we come down, the delta on this bar on the way down, even though actually the delta actually includes the move up and the move down, we can see the delta is about minus 2,000. So we can see that as we come back down, there's no real negative delta. There's no huge push down in delta to say this is actually a big counter trend force coming in. And as we actually get to our spot, we actually trade at the top of this volume cluster. We can see that 1,034 contracts trade there. Now that's not really a quantity that says this is absorption. Okay, what we can actually see, if we look on the way up, we've got much larger volume on the upper side. So what we can see on the way up is that we came down to here, we traded the high of the cluster, and then buyers stepped in, and we can see the delta goes positive, confirming that buyers came in an overwhelming force, and we resumed the move up. Now, we can see here that we created some volume on the way up, or rather, we created some volume. This is actually showing us the way up and the way down. Obviously, one of the problems with footprints is you don't know which volume prints on the way up or the way down. But this volume here is a potential hurdle. So if you took a long of this volume cluster here, you would need to keep your eye out on this volume that printed here, because that is a potential hurdle as we move back up. As it turns out, we managed to get through it. Momentum and bias, obviously, because of the delta shift here, was on our side. And reversal is the least likely scenario most of the time. So the difference between this volume cluster here and this volume cluster here, this one gives us a chance to enter a continuation trade. This one holding would actually be a reversal trade, and that's always the least likely option. Okay, now this image here shows exactly the same move, the pullback to the high volume cluster created in the midpoint. Now the volume profile is probably not going to talk to you at first, but it is actually my preferred tool for reading the order flow or for trying to figure out where people are positioned. So I much prefer to see just the total than to have it split across different footprints. Now one of the key benefits is that the volume profile is very, very easy to read. It tells you everything you need to know at a glance. You don't need to spend 20 minutes at it, trying to look at what happened where. It's just, literally you can look 20 seconds, you can see what's traded where, and then draw your conclusions from that. So what we have here is the DOM with a volume profile. We can see here, this area is the high volume we put in at the low before we started to move up. And then we can see the volume cluster from 1584, 1584, 50 created there. In the middle profile here, we can see that since the profile on the left, we actually came down and traded 1584, 50. Now, how do we know that? If you look at the volumes printed at 1584.25 and 1584, you'll see they're the same across these two profiles. Now, what's also interesting is that 85.25 is now our point of control for the day. The price with the most trades previously was 1582 with 18,100 contracts, and now we have 24,000 contracts at 85.25, and that basically is price acceptance. That is more people willing to do business at successively higher prices, and that is very bullish. Then in the third profile, we start to get an idea of how a high volume node on a long-term volume profile differs from a volume cluster. In the third profile, we start to get an idea of how these high volume areas actually get created. In the middle, we've got this high volume node at 8650, and then over on the right, we can see the volume built up around that price. And the POC, again, the highest traded price shifts up from 85.25 to 86.50. At this point, if we pop up 8 ticks and come back down, we would look for this area to hold, this high volume area here, and we would look for the top of it to hold. So we wouldn't expect to start chewing back down through to the bottom of the high volume area. We would actually expect maybe to trade a little bit 86.75 and then start to move up again. Okay. Now, if it doesn't hold, if we actually do start chewing down just through a couple of prices, then the chance is very high that it's going to go to the opposite end of the range. Now, one of the things also to keep in mind that if we pop up from here, okay, and then we fall down to 86.75, any move down is going to take a lot of time. Okay, so where we have an area where a lot of volume is printed previously, the market is not just going to quickly slide down through that. So at this point in time, any trade, long trade taken here, will see you with any move upwards will be a lot faster than any move downwards. And that is also a very important aspect of the trade management, because you know that a move against you is going to be much slower and actually give you time to work an exit. And a move your way is actually going to be much more rapid and much cleaner. And again, it's not really about risk reward, but it is about giving yourself time to manage the downside effectively. Now, one thing I'll also say is entering the market, when we've got this high volume here, we could, down to 85.25 really. As we're in this range, there's a lot of people who will be scalping this range on either side. The worst trade you could possibly take around here is to enter in the middle. Because as you get into this zone, you get into an area where prices basically wiggle around, range-bound behavior, where it's very, very, very difficult to gauge the direction of the market. So if you try and enter the market in the middle of one of these areas, it's a very, very tough trade to manage because it's just going to be chopping around, chopping around, chopping around. So when you see one of these ranges, it's great to fade the high, it's great to fade the low. It's also great to see it pop up and then take a long at the high, but it's a terrible trade to actually try and buy in the middle. Okay, so I talked a few minutes ago about something called price acceptance. And this slide shows a typical day, typical opening move on the ES. We opened to 1582. We obviously took a little look down to the bottom. We went down through yesterday's value area to the weekly value low, tested that. Market didn't want to go down any further. And as it moves up, people are going to see that we've rejected that area and actually start to buy. And what we can see is as we move up, we build some volume. Okay? Then we move up again and we build some volume. Then we move up again and we build some volume. And this is very, very typical action in a trend day. At each of these areas where we build volume, we've got a couple of things happening. This is price acceptance. This is people, the market moving up and people saying, yes, I want to trade here. This is scalpers trading this range. But it's also areas where all those permafades out there are trying to short the market. So basically the market moves up and they see it slow down and they go short. And they're the people that help fuel the move up. And you can see the move up is on much lower volume. And then we range here. And the permafaders think this is it, I'm going to short. And then we move up. And then we get to here. And it starts ranging again. And the permafaders think this is where I'm going to short. And potentially we could have another move up. So for those of you that understand volume profiles, you can wait for these areas to fall. You can buy the bottom of a high volume area. You can scale some off at the top. And then you can hold for another push up. Alternatively, you can wait for the market to pop out and then come back and retest the top of that volume cluster. Either way, what you're not doing is seeing a volume cluster and then immediately thinking the market slowed down, therefore it's going to reverse. Because if you think of these more as price acceptance, that the market actually likes to do business here, then you'll be more inclined to stay with the overall direction of the market instead of fading it all the time. One final thing about volume profiles and charts. If you look at charts and volume profiles, you notice that you can look at a chart and you can often figure out what the volume profile is going to look like. Now, you can also look at the volume profile and a lot of times hazard a guess at what the chart will look like. So what's the reason to use volume profile at all? Now, if we look at a chart, we can take an opinion on support and resistance in terms of where price went. So at the bottom here would be support, at the top here would be resistance. Now, if we look at the profile, we get a slightly different view. At the bottom here, we can see we have signs of absorption at the bottom of the profile because of this higher volume area. And so the volume profile agrees with the chart. At the top, it's a slightly different story. We have a range of prices where participants traded very, very little, and a range of prices where participants traded a lot. We have this small spike up without a lot of trading. Now, it's an extreme example to illustrate a point, but it is one of the key benefits of the profile. If you're looking at this from a volume profile perspective, which prices are actually more relevant? And I would say that this step here is your relevant price, and something that's really effectively hidden on the chart. So these steps in the profile are key to using the volume profile, and this is why volume profile has some advantages over the chart. It shows you areas that really on the chart don't look important. And that brings us to the close. We've covered a lot of material in this webinar, part 1 and part 2, but I hope the message of liquidity consumption, floors and ceilings helps you understand the commonality between all of the order flow tools. Order flow reading does require the use of discretion. It is like reading a story, but it doesn't mean you don't trade with that rules. It just means that every situation is different, but the overall patterns are recognizable with practice. Thank you very much.
Okay, hi all. My clock says it's about time to start. There are a few latecomers still coming in, so can I just get a quick sound check? Let me know if you can actually hear me. Well done, Bob. You win a prize for being the first one to say yes to the sound check. Right, so hello all. Welcome. This is part 2 of the... Sorry, just let me start my recording. Okay, hello, welcome. This is part 2 of the 4-part macro to micro webinar series with myself, Peter Davies, and Cam Dadwar of the Trading Framework. And today's topic is order flow back to basics. And this will benefit those of you new to order flow, but also for those that might have lost their way a bit with order flow, because there's a lot of distractions in order flow, as it is such a hot topic nowadays, and it's been overcomplicated somewhat with tales of algorithmic trading and HFTs, and we will touch on that today. So a lot of people have gotten quite confused about order flow. So it's a good idea to go back to basics and remember why we use it and what it's actually for. Before I go any further, we have to go through the disclaimer. I will be talking about trading today. You all know the risks. I won't read it out loud to you, but do remember what's not part of the disclaimer is that anytime people talk about trading, they're always talking about it from their own perspective, and that means their own appetite for risk. So, whenever you see something, don't just think about what you're learning, also think about what that person's willing to risk and what you're willing to risk. So you might try and adopt some techniques that somebody's telling you, but if you're not willing to risk the same amount of money, it will not end well. Okay, so those that know Jigsaw, or took a look at our website, because I know some of you are from Cam's audience, you know that we sell a set of tools for reading order flow, and those tools look at both short-term order flow as well as historical order flow. Now that is not what we'll be discussing today, or rather, our focus isn't so much any particular set of tools at all. So what we are going to look at is the theme, or the theory, or the principles behind all order flow tools. And so our objective is to make sure there's no remaining confusion about the theory of order flow, because there's not much point in going through to webinars 3 and 4 if you don't get this stuff. Okay, this is the prerequisite. Okay, so we need you to understand clearly what order flow is, why it's relevant, and how it should be applied. Now, we have done this before. It's been a few years, and I think it's worth getting back to basics so that people don't overcomplicate things when it comes to reading order flow. Now, why exactly do we do a back to basics? Well, I've come across a lot of people that use one order flow tool but have no idea how to use others. So a good example would be somebody that trades cumulative delta divergences mechanically, but they're lost when it comes to footprint charts. So what that means is they don't fully understand the underlying theory behind the tool. So the use of cumulative delta is somewhat superficial. It's done on the basis of using a pattern somebody told them to use, not on the basis of understanding what it's really telling you about market participation. So when those divergences don't work, I actually got an email on Monday. The email was entitled "Doubts about Order Flow and our little ES1 Enter course," and the email said that basically the cumulative delta didn't work on Monday. Okay, now Monday was a holiday. And of course, you know, with anything can break down, a relationship can break down, but Monday was a holiday, we didn't have the same level of market participation, can't expect the market to behave the same way, and that's the kind of thing I'm talking about. So when the divergences don't work, or whatever you're looking for doesn't work, because of change in participation, some people get a little bit lost. So they're reading the words, but not understanding the story, and it's the story that's most important. So with order flow, the 80-20 rule very much applies. That means 80% of the benefit comes from 20% of the knowledge, or 80% of the effects, or the moves, come from 20% of the causes. So you could build encyclopedic knowledge of order flow, but it's mastering the basics that will yield the greatest benefits. Now, we get a lot of people who come to Jigsaw and say, well, what do I need to do? Because you've got like 8 hours or 10 hours of videos on your site. And I say, forget all that, just follow the 20-minute new to Jigsaw tools video, because that gets you the practical experience, and just make sure that you catch up with the theory as you go through. So it's the practical side that's going to get you the furthest ahead with order flow, not really being some kind of guru in order flow. So if you have a head full of order flow concepts and you think you need to keep 1,000 rules in your head to use them, then let's just have a sprinkling. Let's just clear a lot of that stuff out, because the bottom line is that all order flow tools are simply a different view of the same information for the same reason. And after teaching literally thousands of traders these concepts and seeing the results, it's my belief that understanding the theory behind the tools will make the use of the tools more productive. But like I say, it doesn't have to be encyclopedic. So after this session, you should understand the mechanics of price change and be able to understand any order flow tool. Now that doesn't mean you'll be able to use any order flow tool immediately. So these tools are a bit like riding a bike. It does take practice, but conceptually, you should be able to at least assess any order flow tool. Now finally, this session is going to give you actionable information that you can take away and start using in your trading. Now obviously, you're going to need to practice a little bit first. So dip your toe in the water, don't go all in. Now, this is a very old slide, some of you may have seen this before, but we've all faced this conundrum. We have a level that we're looking at, a level we're interested in, excuse me, just set my pointer options. Okay, we have a level that we're interested in. Market could reverse there, could fall short, could poke through and reverse, or it could just blow straight through. So what exactly do we do if we're looking at that level? We've got that level as a level of interest. We could, for instance, if we're interested in fading that level, we could put an order in before the level, you know, and maybe have a wide enough stop, which allows it to move through and come back and still stay in. But you know, if we do that, if we have an entry before the level and a stop right up here, that's going to mean that on your losing trade, you're going to be losing a lot of money. So you could make your stops really wide and get in before the level. You could scale into a trade, so that as the trade moves your way, you add to your position side. That's good, especially if you're on a volatile market where you've got lots of room. But both those things are ways to accept a lack of precision on your entry price. But you don't need to accept that lack of precision. So you can be more precise. So using order flow, you have information to help identify if and when a move is occurring, and then trade it when you have that confirmation. Now that confirmation may come as a turn is happening, or it may come just after the turn, but it will still be a more precise entry. Now we can also use order flow to set bias. Now most markets putting good runs to the upside and the downside on most days. And if you look at the S&P 500 yesterday and crude yesterday, putting in great runs, and that's a side effect mostly of speculative trading. So where people that buy short term aren't so much buyers as kind of future sellers. So on a speculator driven day, we will move in one direction, but then we'll eventually get to a point where those that bought the market, if we moved up, need to unwind their positions by selling, and that activity itself initiates a move to the downside. Then speculators jump on that new short side momentum until they need to unwind their shorts by buying, and then we start moving up. So there's this kind of speculative cycle. It's not something that happens when institutional investing is driving the market. And the order flow helps you to recognize these transitions so you can actually stay on the right side of the market. So when the order flow is biased upside, you only take long signals. When it's biased downside, you only take short signals. If there is no bias, you switch to range bound trading. We can also use order flow to define a pullback or a second entry, and that's a major element to the way I trade. Unlike most people, I have price points I use to identify where a major reversal might take place. Okay, now most of the time, I do not enter there. Now, let's say we've still got some issues with the screen. I am very sorry. Okay, I'll make sure I catch it on the recording. Okay, so we can see the screen now? Okay, sorry about that. Okay. So we can use order flow to define a second entry. Okay, like most people, I have price points I use to identify where a major reversal might take place. Now, most of the time, I don't actually enter the market there. I just think that those areas are too risky places to enter. So I'll let the market reverse or break through a level. I'll let the order flow confirm that that has actually happened. So if I look for a reversal, I want the order flow to confirm that that really was a reversal, not a pullback. And then I'll look for a pullback entry, a second entry. And we know that markets do stair step, and we get hidden backstops created once the move is underway. And these may or may not be visible on the chart, but we will discuss later about how those will be visible on the order flow. Now, people do also use order flow to scalp. I'm not a great fan of scalping. I'm kind of more of a laid-back trader. One of the key things to keep in mind about scalping is that trade location, context, and correlated markets are extremely important. It is not just about order flow. So people aren't switching on their trading PCs, seeing something on the bids and offers, and then just hitting into the market without considering the sort of overall activity in the market, as well as what may be in the moves and obvious hurdles that might be in the way in that market. Now, there are two major components to order flow, and we can separate those in terms of intent and actual. So actual would be what actually trades in the here and now, and intent is what people say they're going to trade, but they might not. So of all the order flow tools, it's only the depth of market and also Jigsaw Auction Vista that's going to show intent. So as a position day trader, you can actually get away without looking at the intent. Okay, so that's right. For many traders, the market depth is not that important. Now, as a scalper, the intent is much more important, but the actual executions, what's really trading, is still much more important than the intent. So what the intent tells you is that people are interested in a level, or people are trying to play a level, and a lot of the time, You know, as you know, the bids and offers are fake or spoof orders placed to make the market look weaker or stronger than it is, but it still tells us that it's an area of interest. Now, that practice has been outlawed in US futures markets, but it's not very easy to police. Plus, when they have policed it, they've really taken out just the small fry. So it's not really outlawed, this idea of, you know, bidding, spoofing, manipulating the market. It's not really been outlawed to any realistic extent. But the fact is, if you see bids and offers really high in an area, it does not mean the area will hold, but it does mean it's an area of interest. Now, it's worth noting that when the market gets into a tight range, such as summertime, Christmas periods, you know, maybe a couple of days last week we had tight range, you might have to turn yourself into a scalper to some extent if you actually want to play that range. I mean, you've got other choices available, and at that time, the intent does become more important at the extremes. Now, the use of actual trade information is what people talk about when they use the term tape reading. And at the end of the day, what tape readers are trying to evaluate is right here, right now, what is going on? Where are other traders positioned? Did we see a stop run? Is one side now in pain and holding back? Is one side trying to aggressively trade into stops? Do we have one side dominant in terms of order size, but no longer getting any price movement for their efforts? Is there an imbalance in trade? These are all things that order flow will tell us, but a price chart won't. So price charts simply tell us where we traded, order flow tells us how we traded it, and who is likely to still be in position, and what reactions might be imminent. Now, in terms of perspectives, when you're looking at price action, you have a lot of people that will use higher time frame and lower time frame charts. But with order flow, it's actually the different tools that give you a different perspective on order flow. So for me, I like to use the cumulative delta to help me set bias and also gauge kind of the strength of a pullback. But I would never use cumulative delta to enter a trade. So you can put the cumulative delta on any time frame chart, but it's really the way they actually present the information that gives them their own unique perspective. And the way I put this is, you know, the higher level, the longer term are the cumulative delta, volume profile, auction vista. Medium term, zoom in a little bit, cumulative delta, volume, footprint charts. I consider those a more medium term order flow tool, tape reading tool. The shorter term, again, volume, but from a slightly different perspective, footprint charts, market depth, time and sales. So those are kind of your short term tools. It doesn't matter, well, in fact, you don't have a time frame with market depth, but it's very much the way they present the information. But they are all presenting the same information for the same reason, and the reason is all related to why price moves. Okay. Now, why does price move might seem like a bit of a daft question, but it is absolutely key to understanding order flow. Now, if you ask somebody why does price move in a market, you can have different people giving you different answers. Now, when I say why does price move, I don't mean why are people buying here. That is a completely different question. I mean, why does the price actually move up and down? Now, some people will say it's because there are more buyers than sellers, but the number of buyers is always equal to the number of sellers. Now, the function of the market, the exchanges, is to just match up buyers and sellers. The market or the exchange doesn't buy off you. All it does is sits there and matches buyers and sellers, and if there's not buyers and sellers, a trade's not going to take place. Okay? Now, in a way, that could have you thinking that order flow is actually complete nonsense, because why analyze the flow of orders when every buy is also a sell? Because, you know, you can think of it, one would really cancel out the other, right? Now, another answer to the question, why does price move? A lot of people say supply and demand, and maybe that's closer to the truth, but not really in the traditional sense we look at supply and demand in traditional marketplaces. With stocks, there is an argument to say that scarcity or lack of shares can drive up prices, and that certainly does happen. But with futures, there's actually an infinite supply of contracts. With stocks, you have a float. There is a finite supply of shares. But with futures, there's an infinite supply. So what happens is contracts will get created and destroyed as necessary when trades occur between two parties. Now, another answer would be more aggressive buyers and sellers, and that's probably closer to the truth, but perhaps less patient buyers and sellers would actually be a better way to look at it. So perhaps a better question we should ask ourselves is, what stops price from moving? So why is it that the S&P 500 futures doesn't trade at 2100 1 second, and then 1260 the next second, and then 500 the next second, and then 5000 the second after that? We know that doesn't happen. And the answer to that question, why does price move, or why doesn't price just jump everywhere, or how does price move, is also the key to reading order flow. And liquidity is the key to why price moves, or rather, the consumption of liquidity. Now, what is liquidity exactly? A lot of people get confused by that term. Liquidity is simply, well, it's first of all, it's the opposite of volatility. So if you think about liquidity and volatility, they kind of sound similar, but basically, more liquidity means less volatility, less liquidity means more volatility. So it's kind of the opposite of volatility, but basically liquidity is simply the availability of the other side to trade with. So if you want to buy, you need a seller to sell to, and the market itself doesn't sell you shares or contracts, it just matches buyers and sellers. So when you trade, you are either providing or taking liquidity depending on the order type. So if you buy at market, then you buy from a liquidity provider on the sell side, okay? And those are the people with sell limit orders. If you sell at market, you're going to sell to a liquidity provider on the buy side, and he's the guy sitting there with bids. So liquidity is limit orders, it's bids and offers, and for a lot of you, it's going to be your eyes kind of glazing over when I use that kind of terminology to explain how it works. Because, you know, for a lot of people, we're talking about liquidity, volatility, bids, offers, and sometimes that's it all sounds a bit confusing. So we're not going to do that. We're going to just look at an analogy, and the analogy is a floors and ceiling. Okay. So here we have a building. It was designed by me. Unfortunately, there are no stairs and no elevator. So let's just imagine this building is the market, and we're now on the top floor. We have a ceiling above us, and we have a floor below us. So to move down to the next floor, you know, what do we need to do? Well, we need to break through the floor below. And the market does exactly the same thing. So the floors and the ceilings are limit orders, and these limit orders need to be consumed or eaten or broken by market orders before we can move through the level. So to move down, we need to break through or eat through the floor. And to move up, we need to eat through the ceiling. Okay, so now we've eaten through the floor, we've broken the floor, sell market orders have eaten the buy limit orders, and we have dropped down. Now, at this point, have a think, what do you think is easier now? Is it easier for us to move down or move up? And the answer is, it's easier at this point to move up because there's a big hole in the ceiling above us, okay? So we broke through the floor, okay? Which obviously, if I look up, it's not a floor above me, it's a ceiling, okay? So right now, there is nothing to eat above us, and there is something to eat below us. I've got no ceiling above, I've got a floor below, and this is very important. Okay, now, the ceiling has been repaired, so it's no longer easier to go one way or the other, and this happens all the way down. Okay, and in the market, here's your liquidity. So here are your floors and ceilings, the bids and offers. So we have the bids on the left, and the offers on the right. Now, some people will say asks instead of offer. Some people will call them resting orders or passive orders instead of limit orders. Okay, but it's just bids and offers. It doesn't matter what you call them. It's floors and ceilings. Now, it's worth noting at this point, right, another thing we have to think about is that markets don't have a current price. Okay, they always have two prices, a buy price and a sell price. So in this image, if you wanted to buy at market, you would pay 2073. And if you wanted to sell at market, you would pay 207.275. Okay, so when you look at a chart and you see the price, okay, that price isn't what you'll pay if you trade. That is simply the last price it traded. It's history. Okay. Now, despite a lot of the resting orders being fake, we still have to get through them. Okay. So if we look at the blue numbers here, we can see the number, the blue numbers here. We can see the number of contracts it actually took to break through the ceiling. So here we can see we traded 17 contracts and we ticked up. 95 contracts ticked up, 10 up, 64 up, 25 up. That's how many contracts it took to eat through the ceilings or eat through the offers. And that is really an indication of how much depth was actually real. So if we look at the offer size here, you can see 75, 81, 103, 89, 113. But the actual trade side, 17, 95, 10, 64. So you can see the difference between the amount of depth advertised and the amount of depth that actually took to trade through that level. Okay. So with the order flow, with the tape, you're getting an indication of how much depth was actually real. So that's how you compare intent and actual. Okay. So that here, the tape, is what really happened. And we'll get into practical application, how to use information shortly. Because it's important to understand one other thing, and the other thing that's important is to understand where liquidity is and where it isn't. Okay. So on the buy side, the floors, there is liquidity below you, and there is liquidity below the 10 you can see, but your data provider doesn't give it to you. It doesn't mean there's nothing down here, okay? The stuff down there, you just can't see it, but there is no buy-side liquidity. There are no bids above the current price. If you put a bid in anywhere there, it will turn into a market order immediately. It'll become an actionable order, okay? So there is no buy-side liquidity above the current price, and if you just think about it, you've never looked up and seen a floor, right? So there are no floors above you. On the sell side, the ceilings, there is liquidity above you. There is liquidity all the way up here, above what you can see, but it's just not visible. Your data provider doesn't give it to you. But there is no sell-side liquidity below the current price. It's impossible. And that is very important. What it means, as we move up into areas where no floors exist, but where ceilings do exist, okay? When we move down into areas where no ceilings exist, but floors do exist. And that moves up means that in a move up, you get a relative liquidity vacuum created behind you. So as we move up through this area, simple fact is, it takes time for the floors to build up in the wake of that move. And in a move down, there's a relative liquidity vacuum created above you because it takes time for the ceilings to build up behind you. And spotting those liquidity vacuums where price pullbacks because of a lack of liquidity and not because of counter-swing trading represents opportunity that a lot of traders really aren't aware of. Now, this is another way to imagine the liquidity picture. Bids getting thinner and thinner as we move up, and offers getting thicker and thicker as we move up, and bids getting thicker and thicker as we move down, and the offers getting thinner and thinner as we move down. Which brings us to another important point. At an area of resistance, right, generally speaking, the ceilings will be very, very thick, and the offers or the ceilings will often be 1.5 to 3 times the bids. In fact, if you're not sure whether a level you're looking at is one that other traders see as resistance, that alone will tell you. Okay, so as you get to resistance, the offers will very often be stacked. But the thing is, that does not mean that the level will hold. Okay, it's the same at lows with support. The bids will be stacked at any valid support level. Now, again, does not mean the level will hold. It's just kind of one of the quirks of the market. It's just the way the market works. So very often, as price gets right close to those thick floors and ceilings, they just suddenly pull out of the way, and the market moves straight on through. But it is a good indicator. So if you're looking at the way you analyze a market and you're looking at a market moving up to one of your key levels that you've got from your analysis, and the bids and offers are absolutely normal when it gets there, then it literally is just you. It's just you looking at that level, and you've got to look at levels that other people are looking at. You know, one of the concepts that you hear from you don't hear it so much now, but one of the concepts you used to hear in trading and trading education was people selling secret levels. And the fact is that if a level's a secret and not many people know about it, it will never hold. Okay, it has to be an area where a lot of people are engaging for it for something significant to happen. Now that's the end of the theory part. We're going to look at why this is relevant. But just remember to recap: at any time, the market does not have a price. It has a floor price and a ceiling price, which is also known as the inside bid and inside offer. And there's a minimum of 1 tick difference between them, and that difference is also known as the bid-offer spread. Market orders consume buy-side and sell-side liquidity, also known as limit orders and also known as floors and ceilings. And when there's no more ceiling to eat, more buy market orders will start eating the next ceiling up, and price will move up with it. And all order flow analysis is basically a variation on this thing. As you move up, a relative liquidity vacuum builds behind you, and often price momentarily collapses into these vacuums before continuing up. And these vacuums present short-term trading opportunities. And it's why you see very often when the market pulls back, the cumulative delta that's showing you kind of net bids minus net sells just stays flat. It's because the market's falling back because of lack of liquidity, not because of sellers engaging. Now, different traders work on different time horizons, taking different amounts of time to fill those vacuums. And what we see is, as we move up, lines in the sand in the form of higher volume areas will build up behind a move. And this is often what ends up supporting price as we move up. So you should always have your eye on the rear view mirror when you're using order flow. Don't just look ahead for obstacles. Look behind you for these liquidity vacuums and these high volume areas that are really good opportunities, really good lines in the sand, and much better trades to take than these, trying to sell the high of the day and buy the low of the day. Okay, well, so what? This is all theory so far. How do you actually kind of turn this into something you can turn into action? And what even is the benefit of understanding this liquidity consumption model? So let's think about the implications of what we've gone through so far in terms of things that we regularly see in the market. The first one's spikes and churns, or rapid moves up versus slow grinding moves up. Now most people will see a fast, rapid move up and they will think that is a strong move, that's strength in the market. But if you think about that liquidity consumption model, you'd know that when you have a rapid spike up, that's actually going to create a larger vacuum, a larger liquidity vacuum behind it, right? And that is actually a sign of weakness. On the other hand, a market that just kind of slowly grinds up all day often gives us the impression that the market's weak. It's just kind of crawling up. It looks like it's going to stop any second, and we end up missing a 50-point down the ES where it just churned up. And that grinding action is actually a sign of strength, because the slower move doesn't get the same sort of liquidity vacuums built behind it that rapid move would. And with less vacuums, you also have less reversal traders jumping on the pullbacks, thinking they're reversal. So what tends to happen is that when a market starts to pull back, everyone's like, oh, sell, the market's finished, it's not going up anymore. And of course, those are the guys that get caught out and actually help kind of the next move up. That tends not to happen on a grindy day. So grinding moves are obviously signs that the market actually likes trading at successively higher prices. So we've all seen markets grind up, waiting for a pullback that just never happens. And those grinding moves can be really frustrating to trade because there's that lack of a pullback. But if you don't see that action as strength, if you see that grinding action as weakness, it makes it really, really difficult psychologically to just actually jump on that move with maybe a small position and build up as you continue. Okay? But if you understand this grinding move is not causing a lack of liquidity behind it, you actually know it's a safer bet to actually just join in that move. It's not likely, probability-wise, it's less likely to just suddenly spike back on you. Okay? Now, retracements or pullbacks can be spotted by a lack of participation in the counter trend move, okay? Which generally means low volume on the pullback, and also the delta or the difference between the sell market orders and the buy market orders is very small, okay? We're not moving back because of a lot of selling, okay? So a market might move down in an uptrend, but if it's because of a kind of general lack of liquidity, the volume, the cumulative delta will not be significant in the move. And part of the reason the market have a tendency to stair step up is that it takes time for the liquidity to fill in the wake of a move. So, of course, we also get these permafader traders who can't stop themselves from selling every move up and buying every move down. As for the end of a move, well, most days are driven by intraday speculation. And for these daytime buyers, once they're in position, they are now people that have to sell to unwind. So as you move up, you're gathering more and more future sellers, and you eventually get to a point where people need to offload. We actually need to kind of shake off some of those sellers before the market can continue moving up. And sometimes that in itself is enough to trigger a reversal, but a lot of the times it just triggers a pullback. So we have liquidity, and we have market orders that consume liquidity, and order flow is all about that process of liquidity consumption. But whose order flow is it we're looking at? And how important is it? After all, there's a lot of different types of participants in the market, and they all impact the market in their own way. And what we're going to cover now is probably the opposite of what a lot of people are saying, and it will probably sound counterintuitive. So I'm going to simplify this a little, because we could really talk for this about for hours discussing the nuances, but we'd still come to the same conclusion, which is that the higher the trading frequency, which is the more frequent the trader, the lower the impact on the market. Okay? And this is important because the participation in the market changes day to day. There aren't many days where long-term institutional repositioning is driving the market, okay? My experience, way less than 1 in 10 days. Yet these traders have a massive impact in price, often generating one-way days. So think about it, major institutional positioning, these guys here, investors and funds, are the least frequent traders, but they have the highest impact on the market when they are trading. On the other hand, okay, the highest discount at the CME on the S&P 500 futures is for traders that trade 135,000 contracts or more per day. Yet those high-frequency traders have the lowest impact on price if we exclude the sort of hiccups caused by the occasional flash crash. So why is that? Well, an HFT is going to buy contracts and very quickly sell them. So any impact their buying has is negated very quickly by their immediate selling. So if anything, they actually help to stabilize price, make price less volatile, because they provide us with liquidity. So these guys down here, they kind of act as stabilizers on the market. But a large fund initiating major repositioning or even hedging, they'll be trading one direction, remember I'm simplifying things here, and then holding for months or years. So on a day where that's occurring, they might be buying for hours and hours to achieve the adjustments in position they want. They could even be doing that over days or weeks. And in all that time, their trading will be predominantly one-sided. And if you're only buying and you're buying a lot of contracts, then that will impact the market much more than somebody that buys and sells and buys and sells and buys and sells an equal amount. Now in the middle, we have swing traders who have shorter holding times, usually days and weeks, and then we get onto day traders. Now, position day traders are those that try to take advantage of major intraday swings, so often staying in positions for hours. Scalpers are generally in and out of the market, just looking for a few ticks, and then HFTs are mostly short-term, market-making arbitrage trades. Now, you may have noticed on the majority of days, most markets put in decent-sized swings in both directions. Okay, they're not directional. They're kind of, ES might go up 10 points, down 15 points, up 14 points, end up settling pretty much where it started. But did you ever really stop to think about why that is happening? So did a fund manager at Fidelity wake up feeling, the economy's great, but at lunchtime he got second thoughts and decided the outlook was really gloomy? Is market sentiment really changing multiple times a day? Well, no, it's not really. That's not what's going on. What's going on is that speculation is pushing the market in one direction. But as we said earlier, when a market is moving up, speculators will eventually have to sell to take profits. And in addition, when a market is moving up, at some point, traders will just simply have built the position size that they're comfortable with and just not want to add more contracts. So you effectively run out of short-term speculators initiating new positions for various reasons. The market slows down as you run out of buyers, and then the people holding long positions need to take profits, see the slowdown, something just gives them the gist, tells them now it's time to get out. They sell off, market moves down. People with no position, or maybe the guys who were long and now flat, they're going to then see opportunities to the short side, and that people jumping on that move sort of snowballs downwards, and that cycle repeats itself over and over again, and the market swinging up and down. And this is the cycle that a lot of smaller traders are trying to take advantage of, even though they really don't think too deeply about what's really going on. Then, of course, we have days where we get big increase in volume, and we know that the big boys play in the market, and the larger institutional positioning. On those days, speculation isn't dominating the market, and the market does behave differently. And that's important because as a trader, it's the actions of the people in the time frame similar to you and above that will have the most impact on trade. So if you're a scalper, the people who are going to have the most impact on your trade are all these guys here. If you're a position day trader, the people who have the most impact on your trade will be these guys here, and the other position day traders. Now, right now, there are so many traders focused on trying to read HFT activity that they lose back to the side that these are actually low-impact traders. So it's much more important on any given day to know if large institutional volume is driving the market, or if short-term speculators are driving the market, or if overall uncertainty is keeping both out of the market. And if you look at what we had last week, we had some great range days, and then we had some fairly horrible days. Yesterday we had a big day. Speculators decided they want to play it today. Today, wasn't very good. It was very, we just saw a lack of participation. There's things that can, give us a clue when that's happening. The VIX index, when that spikes, liquidity decreases. What we see then, there are times when HFTs, do participate to a lesser extent. Like I say, when the VIX spikes, liquidity decreases, the volatility increases, and the market can be a wild ride. But what you're actually seeing there is more a lack of participation in the time frame below you, and so you've got less liquidity to lean on, and the market gets a little bit hairy. Now, of course, new traders would love to be able to pull up a 1 minute chart, slap on a couple of indicators and trade off it without worrying about all this stuff, okay? But this detail, you know, who's playing the market today, is the volume above average? That is the market, okay? That is the market, okay? And that detail is key to understanding the context of the moves that you're seeing on any one particular day, okay? It's not just about candlesticks. It's, you know, you have to understand who's playing this market today. Is there a reason that's brought the investors, the funds into the market, you know, some big news events? And is that followed up, you know, with a lot of volume in the market, directional move? Yeah, it is, okay? Well, I'm going to try and go with that move then. Because I know it's probably not going to, you know, it's probably going to be a one-directional day. Or, you know, have we been sitting in the same range for 2 weeks? Yes, we have. Is there any news? No, there isn't. We're probably going to get a bit of a lackluster day because there's really nothing for, you know, the shorter-term traders, the day traders to kind of, you know, take their cue off. Now, following participation in terms of increase and decrease in volume, as well as the news that could cause the change in volume, isn't particularly difficult. And neither is keeping your eye on the dome to look out for, you know, increases and decreases in liquidity, increases and decreases in the number of limit orders on the dome, which is kind of an indication of whether you do have less market making going on. You know, whether, you know, maybe some of the HFTs are switched off. But it will absolutely benefit your trading. So price charts will tell you where we traded, but won't necessarily tell you about the shifting state of the market. So now we have a feel for the theory of order flow. We've also kind of touched on some other things, you know, volume-based things, and, you know, who's in the market and who's going to affect the way the market's going to move. So let's consider the implication of our order flow model when it comes to reversals. Now, when I talk about reversals, I mean major reversals and minor reversals. And the thing about reversals, you've also got to remember, if you're looking for a reversal and that fails, and that really was a significant level, then you have a slightly different kind of trade, a go with trade, okay? The other thing you need to know about reversals is that just because you see a reversal doesn't mean you have to take a trade, or just because you're looking for a reversal doesn't mean you have to take a trade. It just kind of helps to set, a lot of times, just kind of helps to set your bias, okay? So when I talk about reversals, I'm talking about major reversals and minor reversals. So major reversals initiate a new move, and minor reversals are basically your pullbacks. Because now, based on what we know about liquidity and liquidity being consumed, we can talk about just 3 elements that will cause reversal. Now, not all reversals have all 3 elements, but all reversals have 1 or more of them. Okay. Now the market can only reverse with these 3 elements, and without them, it is not possible for the market to change direction. So generally speaking, most traders are looking for the market to change direction. Whether you're looking at because, you know, the market broke out of a zone and is now returning to it, you know, we're generally looking at some sort of reversal. So we have just 3 elements that will cause reversal, okay? Now some of those are easy to spot in order flow than others, so let's consider them one by one. And what we're going to do, for the sake of simplicity, let's just consider long to short reversals and presume it's the same for short to long. So the first element of a reversal is something called absorption. And this is where the buying continues, but the ceilings no longer break, okay? So the ceiling will either be too thick, or as buying consumes the ceiling, more limit orders come in and kind of build that ceiling back up before it can be consumed. Now this rebuilding the ceiling as it's being consumed is what's known as an iceberg order. In terms of being easy to spot, this is absolutely the easiest, okay? It's kind of it's just right there in your face. You can't miss it. It takes time to do. You know, on the S&P 500, the absorption will take place over minutes. If you look at crude, it's slightly different. It takes place over a series of prices, okay? But still, you can see it. It's very easy to see. What it means is basically the offers, the ceilings, the sellers are stepping up and absorbing all the buying. The buying is no longer able to move the market, and eventually the buyers, especially the late buyers, if you imagine you're buying and buying and buying, yeah, you're joining in this market, you're a short-term speculator, you're buying, it's going up and buying and buying and buying, market stops moving up. Now, it doesn't matter, let's say 3,000 contracts, you know, bought into that level, which would be common on the S&P 500. It doesn't mean all 3,000 have to be short-term speculators, okay? It just means that enough of those 3,000 will be short-term speculators that when they realize they're trapped, that their buying is no longer able to move the market up, there's enough short-term traders there getting out that will help to start to trigger reversal. So in some cases, when that happens, you will be able to join the offers, but it really depends on the market. So on the treasuries, S&P 500, joining the offer is sometimes very difficult when there's an iceberg, but it kind of depends on the type of iceberg. S&P 500 very often will leave you with that fill. Some treasuries traders I know, they manage to get good fills with limit orders. Crude's a slightly different matter when it comes to using limit orders, because when you enter on a limit order with crude, you would do so because you're trying to take advantage of the volatility. So we won't cover that here. We will cover it a little bit later, because, you know, when you have a volatile market that's moving around 7 or 8 ticks at a time, you know, if the conditions are correct, then you don't actually have to wait, don't have to actually get in immediately, okay? You can actually let that volatility sweep you in, but it's a particular type of entry. The second sign of a reversal is buyers fading away. And this is where you get to a price and nobody wants to buy anymore. And sometimes that's a gradual change. So you might say 1,000 contract trade, we tick up, 600 trade, you tick up, 300 trade, you tick up again, and then 45 trade, and we're done. Other times, you have regular trading at one price and you tick up and there's just no one there at the next. So ultra thick markets like the treasuries often just hit one price once. The S&P 500 will tend to go to a level a couple of times, and each time either no contracts or a very small amount of contracts will trade. In fact, the S&P, a lot of people know the S&P as a second chance market, because you've often seen this: you get into a trade, it's not working, it moves against you, it comes back to your entry price, gives you a chance, you don't get out, and then it moves against you. It also does the same thing on the entries. It tends to, you know, move to a price, trade a little bit, you know, move away, go back to the price. It's just really a matter of, you know, kind of understanding the personality of that market. Now this is fairly easy to spot, but quite often you don't have the luxury of time to react as you do with the absorption. And also there is the fact that markets do pour, so you need to be looking for this kind of buyers fading away at a key level, okay, or at a reversal, okay, at a pullback. Because spotting the buyers fading away when the market's already in a weak pullback is much easier to do than when it occurs on a full reversal, okay? There's also a time element to this, because it kind of does take time for the buyers to realize that nobody else is buying anymore. So you will quite often see it will go up to a price and it won't trade it, it'll come away, go up to a price, won't trade it, and then everybody sits there looking at it. And eventually it's like, no, there's nobody left there. And then you start to see people unwind, and you start to see the sellers coming in, which is the third element of reversal, the sellers coming in, or the market rolling over. And this is where you don't so much see buyers fade away, as you just get to a level where sellers start hitting aggressively with size. And many times this will be after the absorption, or after buyers fading away, but other times it's just going to come out of the blue with no warning. You know, just suddenly market going up, not, you know, quite happily market's going up, all of a sudden sellers come in out of the blue with no warning. Now, you're most likely to see, when this happens, sell market orders are going to be 2 to 3 times the quantity of buy market orders. And this is, it has to be said, hard to spot in a timely manner. In other words, by the time you spot this, the market will have ticked down a few ticks. Okay, it just depends on your market. It might be 6 or 7 ticks on crude, might be a couple of ticks on the ES. And at that point, you can decide to get in at a worse price, but more confirmation. Effectively, what you're doing at that point, you're trading a good price for certainty. It does not make it a worse trade, it's just a different trade, okay? So if you see the market go up, you get the absorption, and then you see the seller step in, and you've got decent size on the sell side and not much on the bid side, and you're at a level
Incoming mail.